Welcome to Acera's pre-retirement webinar. I'm really excited to help you all prep for retirement. In this webinar, I'm going to tell you all the things that you might want to know in the 3 years leading up to retirement, or maybe even the 3 months leading up to retirement and the 3 weeks leading up to it, because some of you it may be a little bit farther out, some of you it may be a little bit closer. The bottom line is that you're going to retire soon, and you probably have some questions. Questions like, what do I need to know? What do I need to do, if anything? Okay, so I have arranged the answers to the questions that I think you're going to ask into the form of this checklist. And this is the checklist. These are all the topics that we are going to cover during the presentation. First off, I will talk a little bit about your membership. I'll help you understand that. We'll talk a little bit about your contributions to Acera. I'll show you a retirement timeline. We'll talk about your tier. Then I'm going to talk extensively about estimating your future retirement benefit from Acera. And as part of that discussion, I'll help you understand the retirement formula that we use to calculate your retirement from Acera. I will talk a little bit about considering purchasing service credit. I will help you understand how vacation affects the salary component of the retirement formula. So we'll go into detail on that because everyone's always curious about that. And then I will show you our benefit estimator tool that you can use in your account on our website to get precision estimates of your future retirement benefit from Acera. So that's going to be the first half of the presentation. The second half, I will help you verify your retirement eligibility. We'll talk about choosing your retirement date. I will walk you through the process of applying to retire. And as part of that, I'll talk about the 5 retirement allowance options, of which you're going to choose one on your retirement application. I will also help you understand some other benefits we offer, including medical, dental, and vision benefits. And then we'll talk a little bit about understanding some other life events, and that'll take the entire 3 hours and 15 minutes. So let's jump right in. Okay. First off, first topic, let me help you understand your membership, a little bit about your membership with Acera. So let me start sort of at the beginning. Who is Acera? Acera, in one sense, is this acronym that stands for the Alameda County Employees Retirement Association. But Acera is made up of a lot of people. There are, I think, 92 or 93 of us that work at Acera. We are county employees, like many of you, so we're public employees. And our entire job is to provide retirement, disability, and death benefits to our members. That's you. So you are a part of the who that is Acera because you are a member of Acera. And you're a member of Acera because of who you work for and the position that you work in. You work in a retirement eligible position and you at least started out full time in that retirement eligible position. You may go down to part time later, that's perfectly fine. You can maintain your Acera membership, but you at least started out full time in that retirement eligible position, working for one of the 6 public agencies in Alameda County that use Acera to provide retirement benefits to their employees. So if you work for one of these places in that retirement eligible position, that automatically makes you an Acera member. And in fact, your membership with Acera is mandatory. As an Acera member, you contribute to Acera's fund with every paycheck, and that is called your employee contribution. You can look at your paycheck. This is a county paycheck. All the paychecks may look a little bit different, the pay stubs, but in all of them, there will be a before tax deductions column, and you'll see a line that says something like retirement. Maybe it says your tier. We'll talk about your tier in a minute. And you'll see some money coming out of your check. And that goes into Acera's fund with every paycheck that you get paid. And every time that happens, your employer is also making a contribution on your behalf. So you're paying into the fund, your employer's paying into the fund. So what do we do with all this money? We don't want it to just sit around and collect dust. So we invest it in a diverse array of investments all over the world with the goal of earning interest. And we do, over long periods of time, end up earning a significant amount of interest. So it's these 3 sources of income that give us this big pool of money that we call Acera's fund. Okay, now why are we doing this? Why are we collecting all this money? What are we planning on doing with it? Well, you, in your retirement eligible position, as you work throughout your entire career, are earning more and more and more credit toward retirement. The longer you work, the more credit you earn toward retirement. And you earn credit toward retirement in three categories, which I will talk about in just a few minutes when I show you the retirement formula. So, what's going to happen is that, as you probably have guessed and are aware, at some point, you are going to stop working your job and stop earning credit toward retirement, and you're going to retire. And at that point, you are going to collect the retirement that you have earned every month for the rest of your life in the form of this monthly retirement allowance for life. You get it each and every month on the last business day of the month for the rest of your life. You cannot outlive your retirement. It is a guaranteed source of income that you can plan for in advance, get very accurate projections of because it's defined by a formula, and then you can count on it in retirement for the rest of your life. So it's kind of a beautiful thing to be able to plan in that much detail and be able to count on this source of income for the rest of your life. Now, you'll note as I go through the presentation, I'll probably throw some synonyms around for this idea, monthly retirement allowance for life. I'll probably say pension, pension benefit, retirement benefit, pension allowance. I might mix and match those. They're all synonyms for this same idea. It's this guaranteed benefit that you have earned that you're going to get to collect every month for the rest of your life. Okay. Now, that's kind of basically how Acera works. Let me show you some pension milestones. I like to do this because it provides some context for a lot of the details that we're going to discuss throughout the presentation. You will see all or most of these milestones throughout your membership with Acera. The first one is your date of hire. This is your first day of work in that full-time retirement eligible position. Now, for four of our employers, there's a 2 week lag. So you get hired in that full-time retirement eligible position for that first day. 2 weeks goes by, and the first day of your second pay period is your date of entry into Acera. This is your first day of Acera membership. This is the day that you start earning credit toward retirement. Now, for the Housing Authority and for Livermore Area Recreation and Park District, there is no 2 week lag. The first day of your work in that full-time retirement eligible position is your date of membership, your date of entry into Acera. Okay, now you're an Acera member. What happens? Well, you start working. And once you have worked for 5 years full time, or the equivalent of 5 full-time years, once you have earned what we call 5 years of service credit with Acera, so it's basically you've worked 5 full-time years or the equivalent, you're considered vested in the retirement system, vested with Acera. And vesting is kind of a loose term. It kind of basically means guaranteed. So that's when you start being able to unlock the guaranteed benefits, is at the 5 year mark. Okay, or what some people call the vested benefits. Okay, now what happens? Well, there's some other indeterminate amount of time that goes by, and you achieve retirement eligibility. And it's indeterminate because it's different for everyone. It's based on your years of service credit and your age at retirement. There's a few different combinations that will get you to retirement eligibility. Probably all of you are already eligible to retire if you're watching this. So we'll talk about that in the second half of the presentation. But this is the first day that you could physically retire from Acera if you choose. Now, many people do not do that. Many people continue working past that first day of retirement eligibility to earn more and more credit toward retirement, because the more credit you earn, the higher the payment is going to be, the higher the pension benefit that you're going to get to collect when you retire, which is why I've left a gap here between this milestone and the next one. Okay, so the next one is your termination date. This is your last day on payroll with your employer. This is the date that you leave employment. This is the day that you stop earning credit toward retirement. Now, the next milestone is your first day of retirement. This is your retirement date. It's a date that you choose. You tell us when you want to retire. This is what you put on your retirement application. And this is the day that you start collecting the retirement that you've earned. Now, you'll note that I have not put a gap here between these two dates because many, many people will go straight from active work into retirement on 2 consecutive days. You'll leave work one day, next day is your first day of retirement. But that's not necessarily the case. Some people will have a gap between these days. You'll leave work, you'll defer your retirement to a later date, and then retire on that later date. Perfectly fine. It's what we call becoming a deferred member during that middle period, and then it's a deferred retirement later, but then you just become an Acera retiree as soon as you're retired. And I'll mention that some details about deferred retirement toward the end of the presentation. Okay, so you have retired. You have started collecting your monthly retirement allowance. We're going to pay it to you each and every month for the rest of your life on the last business day of the month until your death. And that is when your retirement payments stop. Now, you'll note there is an additional milestone here, and that is because at the time of retirement, on your retirement application, you have the opportunity to choose a continuance beneficiary, and in some cases, multiple continuance beneficiaries, to get paid a monthly amount after your death. So, in most cases, it will be a lifetime continuance, and the continuance, that word just means continuing monthly payment. So, in most cases, it will continue until the beneficiary's death, and that is when their payments will stop, and that will conclude Acera paying out all of the benefits that we owe you and your beneficiaries that you have earned. Okay. At this point, I want to just orient you to this additional tool that we offer. This is kind of a companion piece to this webinar. It's something that we created because we have figured out that over the course of the 3 hours, we throw a lot of numbers out at you that you may want to remember. Now, you don't have to use the worksheet. You can write them down on a piece of notepaper or however you like to do it. But this is a handy way to record it if you want to. So if you go to acera.org/worksheet, you type that into your browser, or you can navigate to it by going to acera.org, going under news and events, and then you'll see retirement planning seminars down here. And then if you look at the two webinar options, you're currently doing the pre-retirement webinar. So you open up that one and you'll see that there is a retirement planning worksheet. It's a PDF. So what you're going to want to do is go ahead and click the button to download it to your device if you are going to use it, because it is electronically fillable. And if you want to save your work, you're going to want to save it on your device rather than in the browser. And so this just gives you a place to record those numbers. It's 2 pages. I'll refer to it over the course of the webinar, but like I said, it's purely optional. You can do it all on scratch paper too if you want to. Or if you have a really good memory, you can commit it to memory. Okay, so going back to the presentation. At this point, if you want to, you could, in your worksheet, purely optional, write down your Acera entry date if you happen to know it. You'll also note on the worksheet, and my career timeline is on the first page of the worksheet. You'll note that I said approximate dates because if you want to, you could just put in an approximate date if you don't happen to know your Acera entry date. If you know it's like November of 2001, you could put that in there. Also, at this point, if you want to pencil in a projected retirement date because you have one in mind, go ahead and do that. You may learn something during the choosing your retirement date section in the second half of the presentation that may make you want to adjust your retirement date by a few days or a few weeks. So that's why I say pencil it in. Okay, and I just want to say another quick word about vesting. I said it kind of means guaranteed, and I said it happens once you achieve 5 years of service credit with Acera. That also includes reciprocal service credit. So reciprocity is where you have linked another retirement system in California, another pension system with Acera to provide some synergistic effects to your retirement planning. And if you've done that, the 5 years of service credit counts across all of the linked systems, all the reciprocal systems. And the guarantee, I said it means guaranteed. The guarantee comes from California state law. California state law tells us how to do everything. It governs everything we do at Acera, tells us how to calculate everything, tells us how to run the entire system. And that's where the guarantee comes from. And the guaranteed benefits, the vested benefits, are that monthly retirement benefit for life, also an annual cost of living adjustment, which is a percentage increase that you'll receive every year on April 1st in retirement. I'll go into detail about that in the second half of the presentation. And the third guaranteed benefit is this $1,000 lump sum death benefit, which is kind of a basic lump sum death benefit that goes to your beneficiaries. Now, I will explain the five retirement allowance options in the second half of the presentation. Each one of those will carry some additional death benefits with them. Okay, so we'll get there eventually. Okay, so at this point, if you happen to want to record your vested date, you could take your entry date, add 5 years. It's not super important, purely optional. Okay, let's talk about your tier with Acera. You are all in one of these tiers. And your tier that you go into is based on your first day of membership with Acera. It's based on your date of entry. Okay, so first of all, let me orient you to which timeline to look at. If you are a safety member, safety members are sheriff's deputies and probation officers, and there could be some other sworn officers that I'm not aware of that are safety members. You're going to be looking at this bottom timeline. Everyone who's not a safety member is a general member. General members look at the top timeline. Unless you're a general member who works for the Housing Authority or a general member who works for Livermore Area Recreation and Park District, and then you're looking at the timeline for your employer. Okay, so the way this works is if you entered Acera, for example, before July 1st, 1983, as a general member, that would have put you into Tier 1. If you entered Acera July 1st, 1983, all the way up to December 31st, 2012, that would have put you in Tier 2. If you entered Acera January 1st, 2013 and beyond, that would have put you in Tier 4. Okay, so it's based on your date of entry, and if you enter before the cutoff date for the tier, that puts you in the earlier tier. You'll note the Housing Authority has a different Tier 1 cutoff date. LARPD has a Tier 3. They do not have a Tier 2. That's something that they negotiated for their employees. And they have a different Tier 1 cutoff date. And safety members have three different Tier 2s. And if you're a safety member and you entered October 17th, 2010 to December 31st, 2012, that would have put you either in Tier 2C or Tier 2D, depending on what you chose in the first 45 days of your membership. And if you didn't make the choice, you were defaulted into one of the tiers. Now, if you don't remember your date of entry and you don't know what tier you're in, what you can do is log into your account on our website and it will tell you both your date of entry and your tier and a whole bunch of other stuff. And it will allow you to use the benefit estimator, which I'm going to show you later on in the presentation. So let me show you just real quick how to do that. So acera.org is the website again. On the top of every page at acera.org, there's this button, login, sign up. Okay, now this goes to our member portal that we call Member Direct. Now, if you've already done this, if you have logged in here in the past year or so, we relaunched this in the fall of 2024. So about November 1st of 2024. So if you've logged in since then, you've already gone through it, you've already created your account username and password, you're done, you can just log in. If you have not logged in that time, we wiped all the old accounts out from the old portal because we wanted people to create a new login for security purposes. So you're going to have to enroll in the portal. Once you do, all your information will be in there. So your data is not wiped out, it's just the login info. And so what you're going to want to do is click the enroll button here. Now you'll see when you get to the enrollment screen, you're going to need this enrollment pin. And this is not like an instantaneous thing. You're going to have to request an enrollment pin by clicking on the link. You put in your social security number, last name, birth date, home zip code, request pin. And what will happen is that this will generate a letter on Acera's side. We will get that letter in the mail to you immediately. You'll receive it within a few days in US mail, so it does take a few days to get it. And then there will be instructions in the letter that will take you back to this enrollment page. And then you can type in your enrollment pin and fill out the rest of the info, create your username and password, hit enroll, and then you will, from there on out, be able to use your username and password to get in there. And once you get in there, you'll see your tier and your date of entry into Acera. Okay. One more thing that I wanted to mention about that. We do have some videos that help you through that. If you go under members, there's videos. There's a couple of videos here Let me see here. It's a Sarah account login help. This helps you. This is a walkthrough for setting up your account for the first time. And if you ever need to reset your password, there's a help video here as well. Okay, so now that you know which tier you're in, you can mark that on your worksheet if you want to, or write it on your scratch paper, or like I said, if you just already know what it is or commit it to memory, you can do that. The difference between the tiers you'll see is that when we talk about the retirement formula and some of the other ways that Acera works, there will be slight differences between the various tiers. Okay. Moving on to the next section, I'm going to help you get a precision benefit estimate, which is a projection of what you can expect to receive from Acera every month for the rest of your life once you retire. As part of this discussion, I want to first show you our pension formula and walk you through how we actually calculate your pension once you retire, because I think this will help you perhaps do some final dialing in of the three factors in the formula that will help ensure that you're receiving the maximum monthly retirement allowance for life that you have earned. Okay. So I'd like to give you some details about how this whole thing is calculated, and that helps you do that final planning. Okay, so when you go to retire, this is the formula that Acera uses to determine your monthly retirement allowance for life. Okay, so let me walk you through this. In retirement, you are going to get a percentage of your highest salary that you've earned from any point in your career for each individual year of service that you have earned with Acera. Basically, each year that you've worked, you're going to get a percentage of your highest salary. Okay, now this sentence is telling you in English what this multiplication is doing here in math. Okay, so let me give you an example, and I think it will help illustrate this point. Okay, so let's say, for example, that the percentage of your highest salary that you're going to get for each year of service as your retirement allowance is 2%. And let's also say, for example, that you worked exactly 20 years. You earned exactly 20 years of service credit with Acera before you retired. Okay, so what that means is that you are going to get 2% of your highest average monthly salary for each individual one of these 20 years of service. It's essentially like we're taking 2% of your salary and lining it up 20 times and adding them all together. 2% plus 2% plus 2%. Essentially, we're multiplying them together. 2% times 20 is 40%. Okay? So that means that you are going to get, as your monthly retirement allowance, 40% of your highest average monthly salary in this example. Now, let's just finish out the example. Let's say your highest average monthly salary, when we calculate it, when our system calculates it, was $5,000. You were earning $5,000 per month on average during your highest period of pay. And I'll tell you all the details about how we calculate that in a few minutes. Okay. What that means is your monthly retirement allowance is going to be 40% of $5,000, your highest salary. So we finish out the multiplication. 40% times 5,000 is $2,000. So this becomes your monthly retirement allowance for life. So it's actually pretty simple. Now you'll note that because this is a multiplication, the higher any of these three factors in the multiplication, the higher the monthly retirement allowance for life is going to be. The higher the age factor percentage based on you retiring at an older age, and I'll show that to you how that works in just a minute, is going to equal a higher monthly retirement allowance. A higher years of service credit, the longer you work, equals a higher monthly retirement allowance. The higher the salary that you earn equals a higher monthly retirement allowance. So if you can see ways to increase any of these three numbers, and I'll show you some little ways around the edges that you might be able to do that, that maximizes your monthly retirement allowance for life. Okay. Let me talk in detail about each one of how we calculate each one of these three things. Okay. So I'll start with the age factor percentage. Okay. So here's how we do the age factor percentage. There's this chart that we have. This is a sample of some of the age factor percentages. And all these percentages come out of the state law that tells us how to do these calculations. Okay. So you all have a set of these percentages, which is the column for your tier. So what you're going to do is you're going to find the column that represents your tier and just look at that one column. So if you're a general member, you're looking over here. Safety members are looking over here. If you're a general tier 2 member, you're just looking at this one column. Those are the only numbers that apply to you. These numbers don't change, they're written into the law. Okay. So how this works is based on your age at retirement determines, the percentage that we are going to use in the formula for you. So let's say that you are a general tier 2 member and you retire at age 60. Well, we're going to use 1.92% where tier 2 and age 60 intersect. This is the percentage we will pull out of this chart and put into the formula for you. You would receive 1.92% of your highest salary for each year of service credit. Okay. So you'll note that the higher the age factor. Another way to say it is the older you are when you retire, the higher the age factor percentage you'll get in the formula for you, up to a maximum age factor percentage for each tier. And that is denoted by the blue box in each one of the columns. So, for example, if you're a general tier 2 member, you retire at age 65, you would get 2.43% in the formula for you. If you retire at 66 or 67, still 2.43%. So the age factors stop increasing as you age once you reach the maximum age for your tier. Okay. But they will increase up to that point as you age. The older you are when you retire, more you'll get higher and higher age factor percentages. And it's actually based on you aging by the quarter year. Every 3 months you age, there's actually a slight incremental increase. You go up one notch in this age factor percentage chart. All the increases don't fit on the slide, which is why I just have some examples here. But the full chart, if you go out to our website and look at it, it will say like 52, 52 and a quarter, 52 and a half, 52 and three quarters, 53. And every time you age that quarter year, there's a slight incremental increase and you get a slightly higher age factor percentage. And this will be important in the second half of the presentation when I talk about dialing in the age factor percentage when choosing your retirement date. Okay. Let's see. Is there anything else I want to say about this? I think that's it. I think I covered everything. Okay, so that's how we calculate the age factor percentage. Now, how do we calculate the years of service credit? Well, basically, you earn service credit as you work. You start earning service credit when you enter a SARA, and you will continue earning service credit throughout your career as you work until you leave your employer. Service credit is measured in years, so if you log into your account on our website and you've worked 15 plus years, you'll see it'll say something like but you'll see it'll say 15, but we also measure it down to the fraction of a day. So you'll see decimal places after the 15. It will say like 15.782456. All those decimal places are us measuring your service credit down to the fraction of a day. Every 15 minutes you work, you earn 15 minutes of service credit. And so you'll get all of those decimal places in the formula for you, all the way up to the last 15 minutes on your last day working for your employer. So we'll plug all that into the formula for you. Now, you earn service credit during your regular work hours. That will be the bulk of the service credit that you earn. But you also earn service credit during your earned leave times, including earned vacation leave, Sick leave, management leave if you get that, comp time if you have some of that, holidays and floating holidays. When you mark any of those leave times on your timesheet, you're earning service credit during that time. They do not count against you for the purposes of tabulating your service credit for calculating your retirement. Now, there are times when you're not earning service credit. If you ever go on leave without pay, you're not earning service credit. If you purchase additional vacation, which is something that some of our employers allow, they'll let you purchase an extra week of vacation, for example. Whenever you go out on that purchase vacation and you mark that on your timesheet, during that time, you're not earning service credit um, toward retirement. Okay, now sold vacation. Sold vacation is where you sell your earned vacation back to your employer. You don't take the vacation, you don't go out on the vacation, you don't mark it on your timesheet. You're basically just selling that amount back to your employer for cash. Now, that's something that people do. It's perfectly fine. Um, you don't earn any service credit if you sell your vacation, but you will, in many cases, you may get salary credit in the salary component of the formula, which I'll talk about at length in a few minutes. Okay. But you don't get service credit in the service credit component of the formula. Additionally, you do not earn service credit during overtime, on-call time, or standby time. Okay, now I'm just going to cover this briefly because I find that most of the people who were going to purchase service credit when they're watching this, when they're getting ready to retire, have already done so, but maybe not. So I just want to tell you about this concept, and then I'll show you where to get more information on it if you want to. So just briefly, there are some types of time that you may have that are eligible for you to purchase to increase the amount of service credit in the formula for you. The reason you would want to do this is because the more service credit you have, the higher your pension, the higher your retirement allowance that you get paid every month for the rest of your life. So this is one way to dial in that service credit number to maximize that number besides just working longer. Okay. Some examples of eligible time that you can purchase, and you'll note that none of the bullet points say airtime or just like, you just can't purchase extra time if you want to. The law does not allow for that. But the idea with most of these is that you worked a type of time or you incurred a type of time, and the law did not allow for you to earn service credit during the time, but it does allow for you to come back and purchase it. And these include basically the first category is kind of time worked for your employer before your full-time retirement eligible position. Um, I'm not talking about working for a temporary agency or a temp agency or an employment agency or working under contract. Those are not purchasable. But other types of time, like just plain old part-time work for your employer before you achieved your full-time retirement eligible position, or if you worked in the county's temporary assignment pool, that time is purchasable. Project work, there's some other designations in there, including I think seasonal work, intermittent service as needed, those designations, those are purchasable. The 2 week lag time between your date of hire and your date of entry into ACERA is purchasable. Unpaid leave in the categories of medical leave, medical unpaid leave for your medical condition only, not a family member's condition, is purchasable. Disability slash workers' comp leave is purchasable. Military leave, when you go out on military leave, and this is not prior military service, this is military leave when you're actively employed, you go out on military leave and return. That's purchasable. And the bottom line for all three of these is that you go out on the time, when you return from that time, you can buy the time. Medical leave has a limit of 1 year per instance of being out. Redeposits of prior memberships is where you used to be an ACERA member in the past. You were working for one of our 6 employers. You were earning credit toward retirement. You stopped working for that employer. When you stopped, you took a refund of your ACERA contribution account. So you took your money with you, and when you did that, you lost all your service credit from that original membership. Now you're back working here, and you want to get that original service credit back. You can put the money back in, the equivalent amount of money, and in all of these cases, you may You will likely need to pay interest on the money as well. There's more information about that on the purchase webpage. But you can put the money back, and that's called a redeposit of a prior membership, and you get your original service credit back. Redeposits of community property. This is where you were married or in a state registered domestic partnership while you were earning credit toward retirement with a SARA. When you got divorced or dissolved that state registered domestic partnership, since California is a community property state, the retirement that you earned is considered community property, and often it gets divided out, and part of your account goes to your ex-spouse or partner. What they take is part of your money, part of your contribution account with them, and in a proportionate amount of your service credit. Okay. Now, if they, from their separate account, decide to take a refund, we will notify you that they did that. We'll send you a letter in the mail and give you the opportunity to put in back into a SARA an equivalent amount of money to get that equivalent amount of service credit back. And then it's called a redeposit of community property. Other California public agency work. This is where you used to work for another agency in California that has a pension. It's a different pension system, and if you're not eligible to collect a retirement from that pension system, we will allow you to buy that time as a SARA service credit. And usually it's because you either didn't work there for long enough to qualify for their pension, or when you left from their pension, you took a refund. Now there's more info at acera.org/purchase. If you want to watch me take a deeper dive into this concept and talk about what it costs and how to do it, what I recommend is going over to our website. You go to acera.org, scroll down. Okay, sometimes there we go. There's a new employee mid-career webinar here. That's the other major webinar that we do. So you click that. And it's a YouTube video. Just fast forward, just find where I start talking about service credit on that video. So I get to this slide right here. And then I'll take a much deeper dive into this whole topic if you want to do that. It only takes about another 10 minutes, but we have other stuff to talk about in this webinar, so I'm going to keep it moving. And then there's a lot more there's much more description about making service credit purchases at acera.org/purchase. Now, one more thing that I do want to mention, the last thing that I want to mention regarding service credit is what happens to your unused sick leave. So this is important for people to understand who are planning for an upcoming retirement. If you go straight from active work into retirement, so your last day on payroll with your employer is a consecutive calendar day with your first day of retirement. So this is the day that you put on your letter of resignation to your employer. This is the day that you put on your retirement allowance to Acera. Doesn't have to be a Friday and Saturday, but they just have to be two consecutive dates. That means that you're going straight from active work into retirement, and we will convert your unused sick leave to additional service credit up to a cap in your MOU, your Memorandum of Understanding. So if you look at your Memorandum of Understanding, it will say how much of your sick leave that's left over on the books is convertible to service credit. If you've never seen your Memorandum of Understanding, if you contact your Human Resources Department, they can send you a link to it. I think they're all posted up on the web. But what we do is all of the sick leave that is convertible up to the MOU cap, we'll convert to service credit. So for example, a lot of the MOUs, the cap on sick leave that's convertible is 125 days of sick leave. So if you have, let's say for example, you have 130 days of sick leave on the books when you retire that you haven't used yet. Okay, so what we're going to do is shave off that extra 5 days that we're not allowed to convert based on your MOU in this example. So you just lose that 5 days. And then we take the rest that we can convert, the 125 days, we divide it by 2, and we give you that amount of additional days of service credit, 62 and a half in this example. Now, this is not calendar days. This is work days, okay? So if you stretch out 62 and a half days over the work calendar, if you work 5 days a week, That is about 12 plus work weeks. Okay, so you would get about, that's about a quarter year. So you'd get about another 0.25 years of service credit tacked on to your service credit number. And because that's one of the three multipliers in the formula, your retirement allowance goes up by a little bit. It does not push out your retirement date, so don't get confused about that. Your retirement date is your retirement date. All this does is it increases by a little bit the amount of service credit that we put in the formula for you to give you a little boost to your retirement allowance. Okay, so that is how we calculate the age factor percentage. That is how we calculate the service credit. Let me tell you how we calculate the highest average monthly salary component of the formula. When you go to retire, our software, our pension administration system, which has all of your payroll records on file so that we can make these calculations because your employer transmits those to us. It will find your period, your highest period of consecutive pay from anywhere in your career. Doesn't matter if you're making less now, that would mean that your highest period of consecutive pay is sometime earlier. Okay. Most people, the vast majority of people, they're making the highest rate of pay at the end of their career. So that period of highest pay is going to be at the end of the career. Okay. This period in our pension lingo is what is called your final compensation period. Okay. This is the period of pay that we're looking at to calculate your highest average monthly salary. Now, your final compensation period, your period of highest consecutive pay, if you're in tiers 1 and 3, is going to be your highest consecutive 26 biweekly pay periods or 12 if you're paid monthly. I'm not sure anyone is paid monthly anymore. Tiers 2 and 4, it's going to be your highest consecutive 78 biweekly pay periods or 36 monthly pay periods. So essentially, for tiers 1 and 3, it's your consecutive highest year of pay. And for tiers 2 and 4, it's your consecutive highest 3 years of pay. Now, this is, you'll notice one of the differences between the tiers. Okay. So our software has now identified your period of highest pay, either the year or the 3 years, depending on your tier. Then what it does is its goal is to calculate your highest average monthly salary during that period of highest pay. So it simply looks at the total amount of pay that you were paid during that highest period, and it divides by the number of months in that period, divides by 12 or divides by 36 to get your highest average monthly salary over that period. So your total pay over the period is averaged out over the year or 3 years. And this is the salary figure that we put into the formula for you. Multiply it by the other two factors to determine your retirement allowance. Now, what pay is included when we do the calculation? Well, first off, it's all gross pay before any deductions are taken out, but it's only for certain pay types, okay? So the first pay type is, of course, your base pay. This is going to make up the bulk of your highest average monthly salary. There could be some other pay types in there, though, that count. Some people have other pay codes. Sometimes they're called footnotes. And some of these may count and some of these may not. There's like 1,000 different pay codes. So I don't have them all memorized, but you can look them up at acera.org/pay codes. You find the PDF for your employer, open that up, find your pay code, and it'll say yes or no. And make sure you're in the right column for your tier. It'll say yes or no whether it counts toward this calculation or not. The one pay code that I do know that never counts is overtime. Overtime never counts. And if you need help finding your pay code on the sheet, just ask your payroll manager. They'll be able to find it for you. Okay, now I'm going to add two more bullet points. This is the last two bullet points of pay types that are going to be included in the final compensation period. Okay, so these two bullet points here. Now, this is only for tier 1 and tier 2 people. Okay. So the law does not allow for tier 4 to have this type of pay included in their highest average salary calculation. And tier 3, you work for LARPD, your employer does not allow you to sell vacations. So the way the law works is that you're not allowed to do this either. So if you're in tiers 3 or 4, no vacation sales or cash out will be included as salary for calculating your salary. But if you're in tiers 1 and 2, some of it could be included. So let me explain that to you. Let me lay this out to you. Okay. If you're in tiers 3 and 4, you could take a little optional break. We might talk about this for 10 minutes. Okay, so here's the idea. Now we're looking at your final compensation period again. So this is the only period of pay that we are concerned with when we're calculating your highest average monthly salary. And we're looking to see if you sold vacation and or cashed out vacation during the final compensation period. Selling vacation simply means you take your earned vacation and you sell it back to your employer while you're still employed, while you still have a job. That's vacation sale or vacation sell. Okay. If you do that, you earn some compensation for that. You get paid for that. Like they compensate you for your earned vacation that you're selling back to them. Vacation cash out is when you simply have vacation left over on the books when you terminate your employment. So as of your last 15 minutes, when that passes on your last day of payroll, if you still have vacation on the books, they will cash you out for your earned vacation that you still have on the books at that time. I think you'll see it show up in your last check. And that event is you getting paid, you getting compensated for your earned vacation, and that is called vacation cash out, sometimes called vacation payoff. So this happens at termination or retirement. Now, what we are talking about in this little mini discussion about vacation affecting your salary and affecting your retirement allowance, vacation compensation affecting it, is the total vacation compensation that you were paid through a combination of you selling vacation and you cashing out vacation. Now, you don't necessarily have to have done both. You could have done either or, but we're adding it all up and then we are looking at the total vacation compensation between the two. Okay. Now, I just want to make a side note here. If your final compensation period, unlike most people, is at an earlier period in your career, the cash out is not going to count. If you are cashed out for your earned vacation, it's just whatever you sold during that earlier period of higher pay. But that the vast majority of people, like I said, their final compensation period is at the end of your career. And so we would be looking at both potentially. Okay, so we're talking about total vacation compensation that you received during your period of highest pay in your career. Now, here is the kind of underlying theme of this discussion. If you are compensated for your earned vacation during that final compensation period, when we look at your payroll records, when our database, when our system looks at your payroll records, we will see that your total salary during that final compensation period is slightly higher. It is slightly higher than it would have been had you not been compensated for that earned vacation. Because your total salary is higher during the final compensation period, when our software takes an average, your average salary is going to be a little bit higher. Because your average salary is one of the three multipliers in the retirement formula, that means your retirement allowance is a little bit higher. So the bottom line is that if you are compensated for your earned vacation, either through selling it or getting cashed out or both during the final compensation period, that could make your retirement allowance be a little bit bigger. Starting at the time that you retire, that we calculate your retirement allowance and for the rest of your life. So you start out with a slightly higher retirement allowance. Now I say slightly higher. How much am I talking about? Well, here's a chart that gives you an approximation. It's not going to be exactly this, but this is kind of a handy chart that you can use to just get a ballpark estimate of how much it's going to increase your retirement allowance. Okay. So it's based on how many weeks of vacation compensation that Acera ends up including in your salary um, calculation. So let's say that through a combination of vacation sell and vacation cash out, or either or, you are compensated for 6 weeks of vacation, of your earned vacation that you didn't take. So you're paid cash for that 6 weeks of vacation. If you're in tier two, that would increase your retirement allowance at the time of your retirement by 3.8%. You'd get a little 3.8% boost to your retirement allowance as soon as you retire, and you would maintain that higher retirement allowance for the rest of your life. So you'll see that the more vacation compensation that you can get included in your salary calculation, the higher that effect is. And you'll see that for tier one people, there's not a lot of tier one people left anymore, but the effect is accelerated because of the shortened final compensation period. Okay. So now you can kind of see, if you've never heard of this concept, why people are very interested in this concept because it gives you a little boost to your retirement allowance at the time of retirement and for the rest of your life. Okay, now there's a cap on how much vacation compensation a SARA can include in your salary calculation. But you'll note I'm saying can include, but the slide is saying must include. And I just like to mention that this is how the law tells us to calculate your retirement. The law says that there's a certain amount of your vacation compensation that lawfully is considered your salary for the purposes of calculating your retirement. So we must do this. So I just like to point out that little distinction because there are sometimes some observers who are outside of pension systems that have certain feelings about this, but this is how the law tells us to calculate it. So if this is how we're calculating it, I feel it's my obligation to tell you the nuts and bolts of how this gets calculated so that you are fully prepared and you know exactly how a SARA works. Okay. So I'm going to help you now figure out what the cap is, what the maximum amount of vacation compensation that a SARA is allowed to include as salary for calculating your retirement for each of you. So what I'm going to show you first, I'm going to talk to Alameda Health System employees first. Okay. Now what you're seeing here is a section of that retirement planning worksheet that goes along. It's the companion piece to this webinar, and it's available at acera.org/worksheet that you can download. So I mentioned this in the first part of the presentation. And this is just one section of that on page 2 that helps Alameda Health System employees figure this out. Next I'll do the county and other employees. Okay, so if you work for Alameda Health System, you receive PTO, paid time off, hours of paid time off each pay period. And so you, as you know, receive, it's basically like vacation and sick leave lumped into one bucket called PTO. Okay. So all you need to know is how much PTO you earn per pay period. And I believe I've been told that it appears on each one of your pay stubs. So you go look at your pay stub and you see how much PTO you earned in the last pay period. You plug that in here. Okay. Now, if you're in tier one, you multiply that number by 13. If you're in tier two, you multiply that number by 39. And that tells you the maximum amount of hours of vacation compensation a SARA is allowed to include as salary for calculating your retirement. So in this example, it would be 88 hours worth of vacation compensation in tier one or 264 hours worth of vacation compensation for tier two people. So that's the maximum amount that we're allowed to include. Now, there's an exception. If you are an AHS employee and you're in the UAPD union, you don't have to do any math. You don't even have to look at your pay stub. There's a flat cap, and the maximum hours for tier one is 120. For tier two, it's 360. So that would be the maximum amount of hours of your vacation compensation that you're compensated for the PTO that would count toward your increasing your salary for calculating your retirement allowance. Okay, now that's AHS employees. Let me talk to the county and other non-AHS employees. This is a separate part of the worksheet on the back page, page 2. You are going to need to know two numbers. You're going to need to know how much vacation you earn per year, and it's based on your seniority. Okay, so you plug that in here. This person in this example earns 5 weeks of vacation per year every year that they work. I think for the county, let me think. I know once you get 21 years of service, you go up to 5. And I think between 10 years of seniority and 21, you're at 4 weeks per year. I can't remember. I think between 3 and 10, you're earning 3 weeks per year, and you start out at 2 weeks per year. I think that's how that works. But you can check with your payroll clerk to figure that out, or you can look at your pay stub and do some math. Um, okay, so you plug in how much vacation you earn per year, how many weeks. Okay, now the second number that you need to know is how much of that vacation you are allowed to sell if you wanted to sell it. You don't have to sell it, but there's a rule somewhere, either in your employer's handbook, their rule book somewhere, their policies. Maybe it's not even written down. Maybe you got to ask your payroll clerk to figure out what it is. But they'll know and they'll tell you how much vacation you're allowed to sell per year if you choose. So there's a rule. And you put that in here. Now, if you're a tier one member, you just stop here. You just fill in the first column. If you're tier two, you're going to have to fill in all three columns to represent a 3 year final compensation period. Now, this kind of sounds harder than it actually is because you're basically thinking about what your 3 year final compensation period is going to be. So it's your highest 3 years of pay. Like, for example, if you're making your highest rate of pay at the end of your career, you take your projected retirement date, you go 3 years into the past, and that's kind of going to be your final compensation period. And then you divide that into 3 1 year periods and you put in these numbers for each one. Really, what's going to happen in the vast majority of cases is this number is not going to change unless your union renegotiates this. But this rule is not going to change. So you could basically put in the same number all 3 years. So in most cases, this is either going to be a two or a three. I've heard some people can sell four, but in most cases, you can either sell 2 weeks of vacation or 3 weeks of vacation back to your employer. And this one, like I said, it could be that your earnings of vacation increase over that 3 year period, but in most cases it's not going to matter because this number is lesser. And when I show you how this is calculated, it doesn't matter. It's mostly based on these three numbers here. Okay. So here's how this works. You plug in all these numbers, and then we have this calculator out on our website that you can use to plug in the numbers to get your limit of vacation compensation allowable as salary. There's one way to get there is you can type in Acera.org. This is probably the easiest way to do it. Type in acera.org/vacation in your browser. And we've created a shortcut and it takes you right to the calculator. Okay. So you just open this here and you can see that there's a calculator right here. So if you're in tier one, in the example, you would plug in you earn 5 weeks per year or however many you earn and how many weeks you're allowed to sell. And it tells you your maximum weeks of vacation compensation includable as salary. If you're in tier two, it opens up a little bit more and you plug in all the numbers. So I'm just going to continue with that example. They earn 5 weeks per year and they can sell two. Now you'll note what this is doing. All it's doing is taking the lesser of each of the two numbers for each 1 year period and it's adding them up. 2 plus 2 plus 2 is 6. So for example, if you were earning 4 weeks of vacation during that time, and then you went up to 5 weeks, it wouldn't affect the number because you were selling you were allowed to sell two for each one of those 1 year periods. So all it's doing is taking the lesser of each two numbers and adding them up. So 2 plus 2 plus 2 is 6. Okay. So that's how you get the limit. You don't actually need to use the calculator if you don't want to. Okay, so now we know what your limit. This is the maximum number of weeks of vacation compensation. So this is the maximum number of weeks through a combination of you selling 6 weeks or cashing out 6 weeks or some combination of you doing that, you selling or cashing out your earned vacation, you getting cash for it. This is the maximum amount of weeks worth of that compensation that's includable for calculating your salary, for calculating your retirement. Okay. So then what do you do with that information? What do you do with that number? Well, one of the things that you could do, since now I've explained it to you, is you could try to sell or cash out that amount of vacation to give yourself that little boost that the law allows for to receive that higher retirement allowance because this is considered your salary for calculating your retirement. The easiest way to do that is to simply have that amount of vacation on the books when you retire and not worry about selling vacation back to your employer. You just make sure you have at least this amount, whatever your limit is, on the books. We'll cash you out for it. It'll all happen automatically. You don't even have to let us know. You'll get cashed out for your vacation. We'll see that come through in your payroll records. We'll give you the little boost to your retirement allowance. So that's how that works. So that's one way to do it. Now, a second way to do it would be what happens would be to sell some. And I want to give you a different, I want to give you a different scenario to show you a scenario where you may have to sell to get up to the maximum. Okay. In this scenario, this tier two employee, let's say they work for the county, they earn 4 weeks of vacation every year that they work. And they're allowed to sell 3 weeks of vacation. A lot of management positions allow you to sell 3 weeks of vacation per year. So their limit from the calculator is going to be the lesser of each of these two numbers. 3 plus 3 plus 3 is 9. And the reason I'm showing you this example is because your employer has this additional rule that they will not cash you out for more than 2 times your annual accrual rate of vacation. So this person earns 4 weeks of vacation per year. 2 times their accrual rate is 8. 4 times 2 is 8. If they have more than 8 weeks of vacation on the books when they stop working for their employer, they're going to hit this rule and they're going to lose anything above 8 weeks. So if they tried to have 9 weeks, they tried to get up to the limit, they had 9 weeks of vacation on the books, that extra week that is past this rule, it would just go poof. It would disappear. They would get nothing for it, which is why I like to tell you about this rule. So that way, instead of doing that, instead of losing that extra week, you just know about this a little bit in advance. You may even be able to sell this, in the pay periods just before you retire. You sell back to your employer anything above your limit. You sell it back, and then that can get you up to your limit. So the only time you need to sell to get up to your limit is if you can't get up to the limit with the cash out alone because of this 2 times your accrual rate rule. So in this case, they would need to cash out 8 and sell 1 to get up to the 9. Okay, last thing I want to tell you about is the scenario. Some of you may have sold vacation already. What if you already sold a bunch of vacation during that final compensation period? Let's say that this person, the same example, they sold 5 weeks of vacation already sometime during that final 3 years. Okay, well, that's fine. Don't worry. What we'll see in the payroll records is you selling the vacation, and then let's say that your limit is still 9. You have two options here. Your first option is simply to cash out the difference. You would have 4 weeks of vacation left over on the books. You already sold the 5, and 5 plus 4 is 9. That gets you up to the 9. Alternatively, you could even cash out more if you happen to have more vacation than that still on the books, as long as, again, it's not above 2 times your annual accrual rate because you don't want to lose that extra vacation above that. So in this scenario, this person sold 5. All 5 weeks of that vacation compensation went to their bank account. At retirement, when they stopped working, they still had 8 weeks of vacation left over on the books. Their employer cashed them out for that because it was not more than 2 times their accrual rate. All 8 weeks worth of that compensation went to their bank account. Now, that's 13 weeks. So we can't include more than 9 weeks, based on these numbers. That's the max that the law says we can include. But we have to include the 9 weeks because the law tells us to do that. So that means that 9 of that 13 weeks worth of compensation we will consider salary for the purposes of calculating your retirement. And you keep all the money from that 9 plus the 4 extra. All that money went into your bank account. Like you're not paying us to get this extra boost. You're just getting paid because your salary is part of the calculation. And the act of you getting paid this extra money boosts your salary for boosting your retirement allowance. It's a lot of info to throw at you. Do you all have any questions about this before we move on? And feel free to type those into the Q&A. And after we're done with those questions, we'll take a little break. Okay, seeing none. Tier 3 and 4 members, welcome back. Thanks for bearing with us on that. Okay, so let me tell you about a few limits on your monthly payments from Acera. I know the slide says 2025. I actually think I updated the numbers, but forgot to update the title of the slide. Let me just verify that real fast. Nope, I actually didn't update the amounts either. So let's see here. 20, 90. Okay, sorry about that. Well, let me walk you through this. Okay. First off, the top limit doesn't change. Your retirement allowance cannot be higher than your 100% of your highest average monthly salary. That rule is in place basically to try to make it so that you are not earning more in retirement than you are earning as a working employee. But as we just saw, your highest average monthly salary can be slightly higher because of the vacation compensation, but still it, keeps you capped at your highest average monthly salary. Now, if you do hit this cap, that is amazing because that means that in your retirement, you are making the same amount you were making as a working person, working for your employer. It takes a long time to hit that cap. You got to work like 35, 40 years, depending on your age at retirement. So well done. Now, the next two caps are caps for people who have pretty high salaries. So I'm not going to spend any time there because there's not that many people who have those high salaries. But if you do have high salaries like that, you're going to want to read more info about these two caps, these two IRS limits at acera.org/limits. The fourth one I do want to talk about, Tier 4 cap. Um, the law that created Tier 4 back in 2012 took effect January 1st, 2013. Um, Capped the amount of annual salary dollars that Acera is allowed to use to calculate your retirement allowance. And it's based on the Social Security Wage Index limit, which is a number from the federal government that we get every year. So it says that for general members who retired in 2025, um, if you earned more than $155,081 per year, anything above that we were not allowed to include in the salary calculation for you. The way that effectively works during the year, let's say you had a $200,000 salary and you hit the cap, like let's say in October, we would stop taking out retirement contributions from your check for the rest of the calendar year. And then on January 1st, your retirement contributions would kick back in. So it does give you a little more extra money for the rest of the year after you hit the cap for your to save in your personal savings. But again, we're not allowed to use more than those dollar amounts to calculate your retirement allowance, to calculate your salary. These numbers do increase every year. We do post those at acera.org/limits. So here's the page for that. And you can see that the 2026 caps are 159,733 for general members and 191,679 for safety members. Okay, without further ado, let me show you how to get the Precision Retirement Benefit Estimate. I'm going to show you a bunch of screenshots because it works a little better that way. So all you do is you go out to acera.org, you click the login button. Okay, now at the first part of the presentation, I showed you how to enroll. If you haven't enrolled yet, once you're enrolled, you put in your username and password, log in, and then you're going to get to the inside of the member portal. So this is your account in our member portal called Member Direct. This is your account with Acera. And you're going to click on Estimate a Benefit here. Okay. Now I'll zoom in here so you can see it a little bit bigger. What you need to do is plug in two numbers. It's two dates. It's your separation date and your payments begin date. Separation date is your last day on payroll with your employer, which is basically your date of resignation from your employer. Payments begin date is your retirement date from Acera. So if you're going straight from active work to retirement, these would be two consecutive dates. If not, there would probably be a gap between these dates. They can't be the same day. You have to retire at least the next day after your last day of work. Okay, now you can plug in beneficiary info if you want in here. Um, you may see that your beneficiary is pre-populated. If that's the case, just check the date of birth is correct because some of them are incorrect, and if they're incorrect, it'll throw off some of the calculations. And then you hit generate, and I recommend leaving these unchecked for a nice conservative estimate. You hit generate, and you will end up with this. It is a PDF. It is a 4-page retirement benefit estimate. I'll zoom in so you can see your estimated monthly benefit table a little bit better. Okay. You'll see that there are 5 retirement allowance options here. Um, and then this column right here is what you would receive as an Acera retiree every month for the rest of your life, depending on which one of the options you select. Now, we'll go into detail about each of these options a little bit later. For right now, you could just go by the unmodified option if you want to. You just kind of look at that one, but um, we will talk about the other ones in detail later. And then there's a column for what your beneficiaries could receive as a continuance after your death. So we will talk about that later. But there's a page 2 here that talks about the info that it used to calculate the estimate, and pages 3 and 4 actually give you a salary range, and it shows you the salary info for what it's using to calculate your highest average salary. Okay, so this is a PDF. You can make as many of these in your account as you want. You can save them to your device. It will actually keep a record of all the estimates that you've made in your account, so you can get back and see all the ones that you've made in the past. And use this as as much as you want. The tool is there for you. It's available 24/7. If you want to calculate, if you want to write in what the precision estimate that you got from the estimator is into your worksheet, you can do that, or you could just keep them in the same folder, or if you print them out, you can staple them together. So that it's a powerful tool for you to use to get that precision retirement benefit estimate. And you'll note I didn't spend much time on it because it's just super easy. You plug in your dates, you hit submit, and it gives you the PDF. Now, that's the best way to do it. There's another way to do it, which is you can request a retirement estimate from us. If you go to acera.org/forms, you'll see a retirement benefit estimate request form. You could fill that out, submit it to us. We'll do that whole process for you. But what you'll see is that we're both using the same software. So you're seeing the front end, we'll be using the back end, but it'll give you the same numbers because it's all the same software, all the same records. So it's by far the fastest and easiest to just use the benefit estimator in Member Direct, and you can do that as much as you want. If you do this process, we're happy to do it for you, but there's a wait time involved, and we send you the letter in the mail. So that takes extra time as well. Okay, so next section, verifying your retirement eligibility. This one's pretty quick. Are you eligible to retire? When did you become, or when do you become eligible to retire? Well, here's the pension milestone chart again. So we're talking about this milestone, and through some combination of your years of service, credit, and age, that gets you to retirement eligibility. For tiers 1, 2, and 3, I'll show you the three different combinations that get you to retirement eligibility. For tier 4, on the next slide, I'll show you the 2 combinations that get you there. Okay. So combination one, option one for tiers one, two, and three, you have to be at least age 50 and you have to have at least 5 years of service credit with Acera or among all the reciprocal agencies that you have linked together. And you have to have at least 10 years of membership with Acera or all of the agencies linked together. Now, all three of these tiers closed over 10 years ago. So if you're in one of these tiers, you all have 10 years of membership. Don't even worry about this one. You're just over age 50, you have at least 5 years of service credit, you're eligible to retire. Okay, option number two, you have at least, as a general member, 30 years of service credit. Or as a safety member, you have at least 20 years of service credit. You can retire at any age, even if it's younger than the age 50 that you need for option one. Okay, now option three, you can have any amount of service credit and retire at age 70, even if it's less than the 5 years of service credit you need to retire under option one. So you could retire with 4 years of service credit here, as long as you're at least age 70. So you can see that it doesn't actually take that much service credit, a minimum of 5 years in the case of option one, or any amount in the case of option three, to retire from Acera. Now, again, the more service credit you earn and the higher your age will increase your retirement allowance. Okay, so that's tiers one, two, and three. Tier four, you have two combinations. As a general member, you are at least age 52. As a safety member, you are at least age 50. And you can retire with the minimum of 5 years of service credit. So again, it doesn't take much service credit to retire under option one. Option number two, you can have any amount of service credit and retire at age 70 or older. So you don't need to have the 5 years you need under option one. You could have 4 years, 3 years, 2 years, 1 year, or less and retire at age 70 and draw a lifetime pension from Acera under tier four. Okay, so that's how you become eligible to retire. If you happen to want to write in your retirement eligibility date on the worksheet, feel free. If you already know you're well eligible, don't even worry about it. Okay, choose your retirement date. Choosing your retirement date is the next topic that we're going to talk about. What are the things, what are the considerations that you're going to want to think about when you're choosing your retirement date? Because you choose your retirement date. We don't tell you when you're retiring, you tell us. Okay, and it's this date right here on the pension milestone chart that we're talking about, the date that you choose, your first day of retirement, where you start collecting the retirement that you've been earning throughout your career. Okay, so these are the 6 things you're probably going to want to think about prior to retiring. And these are the things that you're going to want to take into account when you're choosing your retirement date. Okay, so I'll just walk through each one of them with you. Number one is it's a good idea, it's purely optional. You don't have to do it. If you know you need to just get out of here, you don't have to think about this, but it's a good idea to think about how much income you'll have after you retire from Acera and think about, will that allow you to pay for your life? Will it allow you to maintain your standard of living? The way that you do that is, of course, to figure that out in advance, you get that precision pension estimate from Acera that I just showed you how to do in your account with Acera. You also are going to want to, if you are a general member and you're paying into Social Security, because general members do, safety members do not, but you may be a safety member who does have Social Security credit from previous employment, go ahead and log into your account at ssa.gov, use their estimator to see what they're planning on paying you when you start collecting Social Security. So get those estimates together. Also, if you have a deferred compensation account, a 457B account, or any other investments, it's a good idea to just go into those accounts, see how much money you have in there to get a full idea of what your total retirement income will be in retirement. If you want to, you can even get as granular as comparing your retirement income to your expenses in retirement. We do have a worksheet on our website that helps you do that. If you don't want to get that granular, a good guideline that financial planners, many of them go by this, is that If the combination of all of your sources of retirement income between your SARA pension, your Social Security, and any additional savings you have, um, equal to at least 80% of what you were making as a working person. So if you're replacing 80% of your working income with retirement income, you will be able to maintain your standard of living. So that's kind of a very, very rough ballpark estimate to get you there, but it is a guideline that financial planners will go by. And in that case, you don't really have to think about your expenses. We do have an expanded article on this. Okay, so if you go out to acera.org, scroll down to this ready to retire section here, and then there is a link, estimate your retirement income, and it walks you through the whole process. It gives you um, a video that walks you through estimating your Sarah pension. There is a link out to log into your account. There's a link to the Social Security estimator. There's a link to your 457B account if you have one. There's some even bonus items, AARP retirement calculator that we just linked to in this budget worksheet from TIAA that we linked to. And that's just kind of like bonus items. Okay. So that's the first thing that you're going to want to think about when choosing your retirement date. So let's see that you have that settled and you're ready to retire and you're saying, what date am I going to retire? Okay, now you may want to think about these age factor percentage increase dates. And the when you want to think about these is if you have not reached the maximum age factor percentage for your tier, as I was telling you in the first half of the presentation. So if as you're aging each quarter year, you're still going up percentage wise in the age factor percentage chart, you're probably going to want to be cognizant of these dates. And it's based on your birthday. So, for example, if your birthday is January 15th, one quarter after your birthday is April 15th, 2 quarters after your birthday is July 15th, 3 quarters after your birthday is October 15th, and then back to January 15th. So every time you pass one of these dates and you age a quarter year, if your birthday was January 15th, that means you go up one notch in that age factor chart. So if you were thinking about retiring, if you were still, if you had still yet not reached the maximum age for your tier to the maximum age factor percentage, and you were thinking about retiring on July 14th and your birthday was January 15th, I would tell you do not do that. You just got to wait one day. You got to work one more day, work on July 14th, retire on July 15th instead of July 14th, and you go up one notch in the age factor chart. And that's the case with all these dates, okay? And you will get an increase to your retirement allowance of somewhere between 1% and 1.9%. And it all depends. The age factor percentages have different gaps in them, but just by waiting that one day, you'll receive a higher retirement allowance starting at the time of your retirement and the rest of your life with an increased retirement allowance of 1 to 1.9% just by making sure that you don't retire right before one of these days. So again, here's the age factor chart. You can see the maximum age for each one of the tiers is in the blue box. So if you're younger than that age for your tier, you're definitely going to want to be cognizant of these dates, okay? Know what these dates are based on your birthday. You just add 3 months to the date, and that's your quarter year aging day. So what I'm trying to tell you is don't retire right before one of these days. What I'm not trying to tell you is that you need to get to the next quarter year date to retire. If you're going to retire like halfway in between July and October, like you're ready to get out of here, you're going to retire on September 1st. I'm not saying that you need to wait until October 15th to retire. Like just go ahead and retire September 1st is totally fine. But I don't want you to retire on October 14th, is what I'm trying to tell you, or right before that. Like that, if that's the case, if you're thinking about a week before that quarter year date, just work the next week. Get that 1 to 1.9% boost. Okay. Um, and then just a quick note for people who have birth dates like on the 31st of the month, where 3 months from now there is no 31st date, your quarter year retirement date would roll back to whatever the last date of that month was. So it would be the 30th. So let's see here. So, for example, if your birthday is August 30th, you have September, October, November, I'm sorry, if your birth date is August 31st, no, there is no November 31st. So your quarter year date that you would pass the next age factor would be if you retired on November 30th or after. Okay. Now, that's the second consideration. Third consideration is the cost of living adjustment date of April 1st. And since we're talking about that, let me just give you a few more details about how the cost of living adjustment works, because this is an opportune time. Cost of living adjustment, like I said, it's a vested benefit. It's a guaranteed benefit. You get it every year. It's a percentage increase to your retirement allowance every year, calculated annually by the CPI, the Consumer Price Index. Basically, if prices go up a certain amount, certain percentage in the San Francisco Bay Area from December to December, that becomes the cost of living adjustment. And everyone gets paid the cost of living adjustment on April 1st who is in retired status as of April 1st. Okay. Now there's a maximum annual limit. Okay, so let's say prices go up in the Bay Area from December to December 5%. Well, we can't give you a 5% cost of living increase. The law limits the cost of living increase for tiers 1 and 3 to 3%, for tiers 2 and 4 to 2%. So we could only give you a 2 or 3% increase depending on your tier. But what we will do is we will bank those extra percentage points for years in the future and we'll keep track of them all. So let's say the next year rolls around and inflation was only 1%. Well, we'll give you the 1% as your COLA plus. We'll take percentage points out of your COLA bank to get you up to the 2 or 3%. Now, you don't have to remember all that and it happens automatically. You don't really have to think about it. The bottom line there is that because inflation in the United States tends to be over 3% on average, it's 3 point something percent if you look at the last, I don't know, 100 years or 50 years or something like that. You tend over long periods of time to bank percentage points. So if you've been retired at least a few years, you tend to have percentage points in the bank and you tend to get uh, the maximum cost of living adjustment each year of 2 or 3%. Okay, now back to choosing your retirement date. April 1st is the day that the cost of living adjustment is posted. Everyone who's already retired, you don't really have to worry about April 1st. Just every April 1st that comes around, you see the cost of living adjustment show up in your April check, which is given to you on April 30th or the last business day in April. But the reason I'm talking to you about this now is because the first year that you're retired is dependent. Which cost of living adjustment you get could be dependent on when you retire. So if you're thinking about retiring in the springtime and you retire on April 1st or before, you will get the cost of living adjustment for that year. If you retire on April 2nd or after, you will not get the cost of living adjustment for that year, but you will get next year's cost of living adjustment when April 1st comes around and every cost of living adjustment after that. It's just that you didn't get that one because we have to cut it off somewhere and the cutoff date is April 1st. Okay. So it does mean that there are some people who, if you're going to retire in the spring, you actually will make a higher retirement allowance by retiring on April 1st or slightly before than you would have made retiring on April 2nd or April 15th or April 30th. So it is more financially advantageous for you to retire on or before April 1st. And this is why March is our biggest retirement month because everyone who is going to retire in, you know, March, April, sometimes even May, they will not retire in April 2nd or all the way through May. They'll dial it back and they'll retire on April 1st because they'll make more money. So we're basically retiring 3 months worth of people all in 1 month. Um, but the rest of the year, like if you're going to retire in February or January or December or November or October or September, just retire when you need to retire. Like, don't worry about the April 1st. Okay. This is the only reason that you would consider this when choosing your retirement date is if you were thinking about retiring basically in April, like, kind of March, April, May timeline. Okay. Now, what happens, the fourth consideration when choosing your retirement date, what happens if there's a dilemma between the age factor percentage and the cost of living adjustment? Okay. So let me give you an example. Let's stick with that January 15th birth date example. You're a general member, you're age 54, and I'm just saying that because you're still somebody whose age factor percentages are increasing. You haven't yet reached the maximum age factor percentage for your tier. And you're going to retire in the spring, and you're thinking, should I retire on April 15th or April 1st? If I retire on April 15th, I'm going to get the age factor increase for retiring for the next quarter year of aging, retiring on April 15th, because April 15th is one quarter after January 15th, but I'm going to miss the cost of living adjustment that I would have gotten had I retired on April 1st. Or should I retire on April 1st? I will miss that age factor increase that I would have gotten had I waited a few weeks and retired on April 15th or after, but I will get the cost of living adjustment for that year. Which do I choose? Well, you probably already know the answer because I already gave you the percentages. What you're going to do is if you're going to retire in the spring, we always post the cost of living adjustment at the beginning of February. So you're going to know what the cost of living adjustment is going to be ahead of time. If the cost of living adjustment is the maximum, you're going to of 2 or 3%, you go with the cost of living adjustment because the age factor increase is only going to increase your retirement allowance immediately upon retirement by somewhere between 1 to 1.9% versus the 2 or 3% you would get for the age for the I'm sorry, the cost of living adjustment. Do not take my word for it. Run two benefit estimates. Okay. If you're going to retire in the spring and you're thinking about this, run multiple benefit estimates, okay? If this person whose birthday is January 15th, they would want to run an estimate for April 15th, okay? In the benefit estimator. So you get that estimate. It will automatically include the age factor percentage increase. So this estimate is going to be higher than this estimate. You run the second estimate for April 1st, okay? Now for the April 1st one, you just take the number and you're going to do a little math. You need to increase it by the COLA amount because the estimator is not going to do that for you. So you take the number, and if you're in tier one or two, I'm sorry, if you're in tier two or four, you multiply it by the 2% increase, or tiers one or three, you multiply it by the 3% increase. So if you're in tiers two or four, you take your estimate, get your calculator out, and multiply by that dollar amount by 1.02, hit enter. It'll increase the number for you. If you're in tiers one and three, multiply it by 1.03. And then you compare that number from the calculator with this number, go with whichever one is highest. Because we want you to get the absolute maximum retirement allowance that you've earned. So you just pick whichever one is highest and you retire on that date. For everyone else who's not retiring in the spring, don't even worry about the cost of living increase date. Just think about the age factor percentage dates. If you're already older than the maximum age factor percentage, retire any day you want. You don't even have to worry about those age factor percentage dates. Okay, last two items in choosing your retirement date. If your plan is to go straight from active work to retired status so that Acera will automatically convert your unused sick leave to service credit, you're going to want to make sure that your last day of work and your retirement date are two consecutive calendar dates. Okay, now if that's not your plan, if you're going to defer your retirement to a later date, don't worry about this part because for people who defer, even if you're deferred for one day, you just lose all your sick leave. So that's just the employer's rules. So on the one hand, it's not Not the best thing to happen. On the other hand, you just don't even have to worry about it. But if you are going straight from active work into retirement, definitely make sure that this happens so you get that little boost in service credit from your unused sick leave, okay? It's very simple. All you need to do is this is the day you write down in your letter of resignation. This is the day that you write down on as your retirement date on your retirement application. Okay. So this is your last day on payroll. It's okay if you're on vacation leave or any type of leave, but this is your termination date and this is your retirement date, and they're two consecutive calendar days. Okay. An easy way to make this happen is we're going to talk about we're going to talk about counseling and uh, making a counseling appointment pretty soon and your retirement application. And I'll show you this again. But on the last step that has the electronic retirement packet, and when I come back to this, I'll show it to you again. But we do have a template here for your letter of resignation. There's a Word file you can download. You just plug in your information, and you say when your last day on payroll will be. You can even tell them what your retirement date is going to be, um, and that's how you resign from your position. Your payroll clerk makes this your last day on payroll. You put this on your retirement application, and you're golden. Okay, now one more consideration here is you're going to want to make sure that you are retiring on a day when you are scheduled to work on the day before, and it should be a non-holiday. Okay, so take what I just told you and make sure that when you retire, you were scheduled to be on you were scheduled to work, even if you're on leave. If you're scheduled to be on leave, that's fine. But you were this is part of your work schedule the day before. Okay. So if you work Monday through Friday, your first day of retirement should be Tuesday through Saturday. Because on Tuesday through Saturday, you normally work Monday through Friday, so you would normally be scheduled the day before. Okay, so if you work Monday through Friday, your first day of retirement should not be Sunday or Monday, because that'll leave a gap and then you'll lose all your sick leave. Okay. If you do not have a regular schedule, perhaps you work in law enforcement, perhaps you work in healthcare. Sometimes you have, very unusual schedules, and that's totally fine. You may want to, instead of choosing a retirement date far in advance, you choose a retirement week. And when you get to closer to that week and you see what the schedule is going to be and you see when you're actually scheduled to work, then you can choose your retirement date and make sure it's on a day after you're scheduled to work. Okay. And again, it's okay if you're on leave this day, but this should not be a regular holiday. So the day, your last day on payroll should not be like Thanksgiving or Christmas or, those regular holidays, because that throws everything off. And that's how you choose your retirement date. Okay. So, if you want to record your projected retirement date, now that you have some more information about that, feel free. Now that you know your separation date should be the day before, these should be two consecutive days. If, again, you want us to convert your sick leave into service credit. Okay, so let's talk about the retirement application process. Hang on one second. Bear with me for one second. Okay, let's talk about the retirement application process. So I'm going to walk you through this step by step. Okay, step one is a step that has sub steps. We want you to go through the preparing to retire section. So that is at acera.org/prepare is the shortcut to get there. If you're over at acera.org, you can get there under members. It says preparing to retire here, or you can scroll down here, prepare to retire. It all takes you to the same place. Okay, so you can see that there are 12 posts here, and this is in chronological order. So we want you to go through each one of these items of content. We would also like you to do any of the things that need to be done in here, but you have already done a lot of this stuff, so you may not need to do all of this stuff. We've already verified your retirement eligibility. I already told you how vacation pay affects your pension. You're attending a pre-retirement seminar right now. So you've already done a lot of this stuff, but there is some other stuff that we want to make sure we need, make sure we have documents and proof of name change on file. We've already talked about choosing your retirement date. Okay. So we just want you to go through this whole section. That's step one. Okay. Step number two, set up a ready to retire counseling session within the 3 to 6 month period before your retirement date in order to fully prepare. Okay, so 3 to 6 months ahead of time, you go to acera.org/counseling and you fill out the counseling form. Now, going back to that preparing to retire page, you'll note it's the third to last step. So schedule a ready to retire counseling session. All you do is you fill out all of the info and then you hit submit. And my colleagues, who are the counselors, will contact you and they will set up a counseling session with you within the 3 month period before your projected retirement date. Okay. And they'll give you more information and more stuff to do at that point. So that's step two. Step three, submit a retirement application. So I believe your counselor is going to tell you that you should submit your retirement application prior to the counseling session. Okay. And you're going to submit that within the 90-day window before your retirement date. Now, the shortcut to get there is acera.org/retire, which, going back to the preparing to retire section, you'll note is the last step, applying to retire. And this page, it has some sub steps to make sure that you did all the stuff, to make sure you attended the seminar, you did that, set up the counseling session, you did that. It does walk you through all of the 5 retirement allowance options. And then it gets to the electronic retirement packet. Okay. This is the electronic retirement packet. It's all DocuSign forms. You don't have to get printers or pen and ink involved in this stuff. So you just click on the DocuSign button and you can fill it all out online. And, there's some more forms and there's some other info here in the electronic retirement packet. Okay. And again, this is the page. There's some more info below here. This is the page that has, there's a list of additional things that you're probably going to want to do. And this is where that letter of resignation template is. So it's some additional things after you submit the retirement application. So that's step three. Okay, on the retirement application, on the DocuSign retirement application, you are going to do a few things. You're going to specify your retirement date. You're going to select one of 5 retirement options. You're going to nominate a beneficiary or beneficiaries for your death benefits. You're going to consider joining a retiree association. I'll talk about those briefly in just a few minutes. And then you submit the retirement application. We log it into our system. We log in your projected retirement date that you have put on your application into our system. And once your retirement date passes, you're retired. It's going to be amazing. You have earned it. You've worked a long career providing services to the residents of Alameda County. You've worked very hard. You've earned a substantial retirement, and we wish you an amazing retirement. And it's just going to be awesome. Okay, so we're really excited for you to retire and to help you through this process. Okay, so once your retirement date passes, you're retired. Okay, now going back to the worksheet, just real quick, if you want to write in the day that you submit the Ready to Retire counseling form, just take your projected retirement date, subtract 6 months, and write that in. And then don't stop there. Go on your planner, your calendar, how whatever you use to remind yourself of doctor's appointments and stuff like that, and put in a reminder for that to submit that Ready to Retire counseling form. Now, if you currently right now are less than 6 months, less than 3 months from retiring, don't worry. Just go ahead and submit the counseling form, and we will try to get you scheduled in for that counseling session within that 3 month period prior to your projected retirement date. Okay, now a quick word about retiree associations. And this is something that you can select on your retirement application. There's a checkbox for each of these. It's very easy to sign up for these. You just check the box on your retirement application. Okay, there's two retiree associations, and these are retiree associations of Alameda County retired employees. ACRE is the Alameda County retired employees. It's affiliated with SEIU Local 1021. The dues are a super cheap $3 per month. REAC is retired of employees of Alameda County. They're unaffiliated. Dues are an incredibly inexpensive $2 per month. And all these retiree associations do is advocate for ACERA retirees. They publish newsletters, they hold social events. ACRE holds a holiday luncheon, REAC holds a spring and fall luncheon, and they do other stuff. They send you the newsletters, and they attend all of our committee and board meetings. I attend all of their board meetings because we like to keep a close relationship with the retiree associations, and it's just another way for Acera to hear, what's going on with retirees because these associations are strong advocates for you. You can read more at acera.org /retiree dash associations. And like I said, you can sign up for them on your retirement application. And once you do that, we will just deduct the dues from your retirement check and send it over to those organizations for you. You can sign up for one of these or both. You can expect your first retirement check once your retirement date passes within 4 to 6 weeks after your last employer's paycheck. Now, in 99.9% of the cases these days, because we start the retirement process so early, we have you sign up for that counseling session 6 months ahead of time. And to get the ball rolling, 99.9% of the time, your first payment will be your final 100% payment of your retirement allowance. We've already done all the calculations. But there are some occasional times where there's missing documentation or other issues, and then we'll start issuing you payments within the first 4 to 6 weeks. But it'll be an estimated 80% payment until we resolve the issues, and then we'll get you any retro payments for any less than 100% payments we had to make. Okay, so now let me show you the 5 retirement allowance options. Okay, so it's good to understand these. It's good that you are participating in this webinar because you need to understand what all 5 of these do because you are going to select one of these on your retirement application, and you can't modify your choice later. So whatever you select, that's going to be your choice for the rest of your retirement and the rest of your life. There is one scenario where if you are going to apply for a disability retirement and you go ahead and do the regular retirement, what we call the service retirement first, while you're waiting for the disability retirement, because that can take like a year, up to a year. I think that you can, if you are awarded the disability retirement, you can select a different option, but you would want to check with your disability counselor on that if you're going through that process, just to make sure I'm not giving you bad information. Otherwise, your choice is permanent. Okay. So I'm going to walk you through each one of these 5 options. And for each one of the options, I'm going to show you a slide. The top title is going to be the title of the option. And then there's going to be a table with a lot of text. I'll walk you through all of it. Okay. The top row of the table is going to talk to you about what you are receiving, what you will receive as an Acera retiree. The bottom row or rows will tell you what your beneficiaries will receive upon your death. Okay. So It looks like a wall of text, but let me walk you through the whole thing. Okay. So this is the first option. The first option is called the unmodified option. This is the option that the vast majority of our retirees select when they retire because it pays the maximum retirement allowance of any of the five options to you as a living Acera retiree. Now, what it does after your death is that it leaves a 60% monthly continuance to your qualifying beneficiary. Now, again, a continuance that is simply a continuing monthly payment after your death. Okay. If your beneficiary is your spouse, state registered domestic partner, or Alameda County domestic partner, that continuance will last for the rest of their life. As long as you can only name them as a continuance beneficiary, as long as you married or registered them at least 1 year before your retirement. Okay. And just to define the word beneficiary, beneficiary is just somebody who gets benefits. So your Acera beneficiary is the person you designate to get your death benefits after your death. Okay. Now, um, if you select the unmodified option, but you don't have a spouse or domestic partner, but you do have minor children, you can name one or more minor children as your continuance beneficiary. However, it's not a lifetime benefit for the rest of their life. It's a temporary benefit. It will cut off, it will stop once they reach age 18, unless they maintain enrollment as a full-time student in an accredited school, at which point it will continue until age 22, at which point it will stop. Unless they marry or register a domestic partner with the state before that, and at that point it'll cut off when they get married or register that domestic partner. Okay, so that's who's eligible for a continuance beneficiary. Let's say that you are getting ready to retire, you want to select the unmodified option, but you don't have any of these people to leave a continuance to. Can you select the unmodified option? Absolutely. You can even name a beneficiary. But whoever you name, because they're not one of these people, they're not eligible for a continuance with the unmodified option. They're only eligible for a lump sum payment, and we call it a lump sum payment because it's a one-time payment. It's not a continuing payment. And they will receive basically the balance of your contribution account, your employee contribution account that you paid into Acera. So all the contributions you paid into Acera over your entire career, plus all the interest that we've posted to your account, because every time the fund earns interest, we post interest to your account, minus all of the retirement allowance payments that we've already paid you as a retiree. Okay. And when you retire, we start paying out of that money first. So that means that if you die after your first 3 to 5 years of retirement, that employee contribution account will be entirely exhausted and there will be no lump sum payment from that contribution account to pay to a lump sum beneficiary. Now, there will be other amounts that we can pay to a lump sum beneficiary, so you can still name them and they will still get the lump sum payments. There's a $1,000 lump sum benefit. There is a partial month of your retirement allowance. If you died at some point, like halfway through the month, and we were not able to pay you that retirement allowance yet, we will pay your beneficiary. Also, if you enroll in our group medical plans, you pay those premiums a month in advance. We'll refund those advance paid premiums, so they'll get all that money paid out to them. Um, and this is a kind of an aside, but it's an interesting thing. Kind of the implication of your employee contribution account and interest being exhausted within the first 3 to 5 years of retirement means that everything that you paid into in all of these cases, as an Acera retiree, everything that you paid into Acera throughout your entire career and the interest, we give it all back to you within your first 3 to 5 years of retirement. And then everything after that, it's almost like an amazing bonus that you get to have for the rest of your life, beyond, what you paid in the system. But really what's happening is we're also paying out of the employer contributions and the interest, and we've invested your money very well, and it's the interest that pays for 3/4 of your lifetime benefit. And that's just the way the system works. So it's your advantage for participating in a defined benefit pension plan. Okay, that's an aside. Back to the unmodified option. Okay, one more thing I want to say about this. Let's say that you are choosing the unmodified option, and at the time of retirement, you have one of these people to name for a monthly continuance. You retire, but your beneficiary dies before you do. In that case, you can name a new beneficiary, but not for continuance payments. The only opportunity that you have in all cases to name a continuance beneficiary is at the time of retirement on your retirement application. Any beneficiary you name after retirement, they will be eligible only for those lump sum payments that I mentioned. Okay. And that includes like if you are not married at the time that you retire and you get married and you retire, you get married in retirement, you can name your new spouse as your beneficiary, but only for the lump sum payments. Okay, so that's the unmodified option. Option number one. This one is the only one of the five options that never pays a continuance to anyone ever. This is a lump sum to the beneficiary benefit only. Okay, now what this does for you as an Acera retiree is this pays slightly less than the unmodified option. So if you compare what the unmodified option pays to option one, it's a little bit less. What it does is it will extend the time that there's a balance left over in your contribution account from 3 to 5 years to 10 to 12 years. So if you were to die after retirement within that first 10 to 12 years, there would still be a lump sum balance in your contribution account to pay out to your lump sum beneficiary. So the reason that people might select option one is they're looking at the unmodified option, they want to get the maximum, and they're okay, and they don't have somebody to leave a continuance to, and they're okay taking a slightly lower retirement allowance in order to extend the probability that if they were to die early, there would be an amount left over for their lump sum beneficiary. So that's the main reason that people select option one. Just as a side note, for continuances, you can only choose people. You can only name people. You can't name trusts. You can't name charities or estates, anything like that. So it has to be a human with a lifespan. Um, but if you wanted to leave try to leave a large lump sum to like a charity, you might select option one. Okay, option two. This one is subtitled 100% to beneficiary. Okay, so what this does for you, for your retirement allowance, is it pays less than the unmodified option. That's one of the first things that it does. And it does two other main things for your beneficiary. The first is that rather than paying a 60% continuance, like in the unmodified option, it pays 100% continuance. What do I mean by that? Well, if you chose option two, at your death, whatever your retirement allowance amount is at that time, including all of your cost of living increases that you've gotten, that's what your beneficiary starts receiving, that same amount for the rest of your life. It's 100%. For the unmodified option, it's only 60% of that amount. Okay. So that's the first thing it does. Second thing it does is it expands the group of people you're allowed to name as a beneficiary for a lifetime continuance. It's not just spouse or domestic partner or minor children, it's anyone. So if you have an adult child, you cannot name them for a continuance in the unmodified option, but you could under option two because you can name anyone. Okay. Now there's some caveats here. One caveat is that if you're trying to name somebody who's not your spouse and is more than 10 years younger than you, there's this very arcane IRS calculation that may prevent us from paying exactly 100%. It might be like 96% or 93% or 89%. There's a very bizarre calculation. If you're interested in what it is, you can go out to acera.org/retire. Okay, going back to the top of the page. You go down to step three, which is the five retirement allowance options and you go down to option two, okay, there's a link here that walks you through this. It doesn't make any sense to me, like how they're calculating this, but it could be that we have to pay your beneficiary less than 100%, that we can't pay them the full 100%. Okay, that's one caveat. Second caveat, you retire, you choose option two, you name your beneficiary. If your beneficiary dies before you do, after you retire, we do not recalculate your retirement. And at the time of retirement, what we did was we calculated your retirement allowance based on your beneficiary's life expectancy. So if they're significantly younger than you, they have a longer actuarial life expectancy. We expect to pay them more, so we're going to pay you less. And all of that calculation is baked into your retirement allowance at the time that we calculate it at the time of your retirement. So we will reduce your retirement allowance based on your beneficiary's life expectancy at the time of retirement. And if they die before you do, we don't increase your retirement allowance because your beneficiary did not live out their actuarial life expectancy. Your retirement allowance, whatever it's calculated to be at the time of your retirement, is what it's going to be for the rest of your life, plus cost of living increases. Okay. So again, if that does happen, you can name a new beneficiary, but only for lump sum payments. I think that's all I need to say about option two. Option three is almost the exact same thing as option two, except it pays less to the beneficiary, so it pays you more. Okay. So it's going to pay a 50% continuance to your beneficiary, but basically it's the exact same thing as option two. Um, so you will receive more in your retirement allowance. Again, it's less than the unmodified option, but it's more than option two because we're paying the beneficiary less. And they would receive a 50% continuance, lifetime continuance. You can name anyone for lifetime continuance. All the same rules apply. That IRS thing doesn't apply here because none of the reductions get down to 50%. So we've already reduced it to 50%, and that's what it's going to be. Okay, then option four. Sorry, option four. Option four is the last option. This one is very similar to options two and three, but it gives you a lot of leeway in what you want to leave to your beneficiaries. You're not stuck with 100% or 50%, and you're not stuck only leaving a lifetime continuance to a single beneficiary. Because options two and three, you can only leave that 100 or 50% to one beneficiary. Option four, you can name multiple beneficiaries for lifetime continuance, and it doesn't have to be 50 or 100%. It could be anything, up to 100% total. So, for example, if you had two adult children that you wanted to leave a lifetime continuance to, you can't leave a continuance to them under the unmodified option because they don't qualify, they're adults. And under all the rest of the options, you can only name one beneficiary. So here's where you can name two beneficiaries. You could leave each of your adult children 50%, or if you get your retirement estimate back and that you don't want to be leaving the amount of the reduction, because the reduction is still based on your youngest beneficiary's life expectancy, it doesn't leave you enough to live. You could leave them a lot less. You could leave two adult children 20% and 20% continuance, or three adult children. You could leave them a 10, 10 and 10, or 15, 15 and 15, as long as when they all add up, it's not more than 100%. Or you could specify a dollar amount. You could leave them each $1,000 continuance, as long as it's not more than, the 100% again. All the same rules apply as options two and three, but you can choose, or you could just choose one beneficiary but leave them something other than 50 or 100. Like you have one adult child, you could leave that one adult child a 20% continuance, okay, or a nephew, or a friend, anything like that. Okay. Now, one thing that I like to point out to people here. Um, so that's the five options. So when you're choosing your option, and you're considering, if you are considering options two, three, or four, where you're leaving a lifetime continuance and you are considering leaving a continuance to your adult children, that is a very beautiful sentiment. That is a very beautiful gift that you are intending to leave to your adult children. That's beautiful. Okay. Another, alternatively, another amazing gift that you can give to your adult children while they're still alive is your financial solvency for the rest of your life. So they don't have to worry about you. So all I'm saying is if you're choosing options two, three, or four, and we're reducing your retirement allowance because gonna, you know, we're basing it on your beneficiary's life expectancy, just make sure that it still leaves you enough retirement allowance to live comfortably for the rest of your life, because that way they won't have to worry about your they won't have to worry about you at all regarding your income in retirement. So they can do their own thing and not worry about um, your retirement status for the rest of your life. And in many cases, your adult children are going to have many more earning years ahead of them to, earn their own retirement. Okay, so I just want to revisit the retirement benefit estimate one more time since we have gone through each of the options. Okay, so again, this is the PDF benefit estimate that is generated by Member Direct. And when you generate it, now you'll note that the unmodified option is the largest of the member monthly benefits projections in the member monthly benefit column. It's the largest one because it pays the most. You'll note that the beneficiary continuance after your death is 60%. If you do the math, it's 60% of this amount. You'll note option number one, the beneficiary continuance is grayed out because it never leaves a continuance to anyone. It only pays a lump sum. And you'll note that option two, your projected retirement allowance is the same as your beneficiary's projected retirement allowance because it pays 100% to your beneficiary. And you'll note the same with option three. The beneficiary's projected continuance is 50% of your continuance. And you'll note that option three pays you more than option two. So all the stuff kind of clicks into place and makes sense on the benefit estimate once you know how each of the options work and what they do for you and for your beneficiary. For option four, we currently are not providing estimates on this yet for option four. So you will need to work with your counselor during the counseling session to get estimates for option four, different, scenarios for option four. However, we will, in the first half of this year, be upgrading this system so that we can do option four estimates right on this. Okay, let's get into understanding some other benefits. Next section. Okay, so when I say, let me go back here. Okay, we're understanding other benefits. The first benefits that I want to tell you about are what we call either non-guaranteed benefits or non-vested benefits. The reason we do that is to contrast them with the guaranteed benefits, the vested benefits, the cost of living adjustment, the retirement allowance, the death benefits. Okay, these are not guaranteed benefits. These are extra benefits that we provide based on the sustainability of this reserve fund that we maintain. So what happened was back in the 80s, the county decided that they wanted to provide additional benefits to the people who were retiring from the county through ACERA, and so they started this reserve fund. And Alameda County is the only county in the state that has a reserve fund like this. There's two other counties that have a reserve fund, but it's not very well funded. So we provide a higher level of these additional benefits than any county in the state because of this reserve fund that we have. It's called the Supplemental Retiree Benefit Reserve. And It is run by our board of retirement, the Acera board of retirement, and they just keep track of it. They have an actuary annually, see how much money is going out in benefits, see how much money is coming back in interest, and their whole goal is to keep the fund sustainable because they want to continue offering these extra benefits to you all in perpetuity. So they don't want to keep the fund sustainable in order to be able to do that. And one of the ways that they ensure the funds stay sustainable is they set up criteria for who can access these non-guaranteed benefits, these extra benefits. And one of their main criteria is they want you to have at least a certain amount of years of Acera service credit to start qualifying for the benefits. This is reciprocal service does not count here, only Acera service credit. And you'll note that it starts with 10 years of Acera service credit for most of the benefits. The supplemental cost of living adjustment is the only one where you don't need a minimum amount of Acera years of Acera service credit to qualify. Okay. So these are the benefits are this medical subsidy, which is known as the monthly medical allowance. There's three levels of it depending on your years of service credit. There's also a dental and vision subsidies and a Medicare subsidy. So let me give you some more details about each one of those and show you our medical, dental, and vision plans. Okay. So I'm gonna both show you the subsidies, which is money that you get to pay for the cost of being enrolled in our plans, and I'm gonna show you the plans. First off, we'll start with the medical. Okay. So we have the monthly medical allowance. This is the subsidy. So I'll talk about the subsidy, then I'll show you the plans. First off, we just like to reiterate, none of these are guaranteed benefits. Monthly medical allowance is not guaranteed, but we want to continue offering it. It's just that the board, they make sure that we have enough money in the fund to continue offering it. Just as an aside, that fund currently has $1.1 billion in there, and it's considered pretty sustainable at this point. If you ever wanted to read more about that fund, you can go to acera.org/SRBR. And there's more information here, and it talks about the longevity of the fund, and it gives you more information. There's reports on that. Okay, so monthly medical allowance. The entire purpose of this subsidy, the monthly medical allowance, is to offset the cost of you being enrolled in our Acera sponsored medical plans. So when you stop working at your job, you're not going to be able to be on your employer's medical plan anymore. Now you kind of can because for 36 months because of the federal COBRA law. So you could choose to keep that, but you'd have to pay the whole way, and it's you would see that it's a little pricey. So we offer you the ability to enroll in medical plans, and then if you qualify, we offer you this subsidy to help offset the cost of being enrolled in our medical plans. We don't currently offer this subsidy for if you enroll in an outside plan outside of one of the ones that we sponsor, but we do have a lot of choices. We have group plans, and the MMA covers the monthly premiums or offsets the cost of the monthly premiums. We do have individual plan options, and it offsets the cost of not only the premiums, but co-pays, deductibles, and other IRS-approved medical expenses. The amount of the monthly medical allowance is set annually by the Board of Retirement, and they do that to maintain the sustainability of the fund. Any costs above what the monthly medical allowance pays, you are responsible for paying. And it is not available to subsidize others being enrolled in your plan. Now, you can enroll them. You can enroll spouses, children up to age 26, and such, but they are not eligible for the monthly medical allowance subsidy, so you have to pay their whole premium. Okay, here are the monthly medical allowance amounts for 2026. If you retire with 20 or more years of Acera service credit, the monthly medical allowance amount is $687.21. So that's the dollars the monthly dollars you would have to offset the cost of your plan. If you retire with 15 plus years of Acera service credit, The amount is $515.41 for 2026. If you retire with at least 10 years of Acera service credit, it's $343.61. And below 10 years, you're not eligible for the monthly medical allowance. Okay. So just remember those dollar amounts because I'm going to show you the plans and the premiums, and so you can see how much of the premiums that the subsidy pays for. Okay, so what you're seeing here is a list of the plans. And in general, just as a note, our open enrollment is the month of November. So we have a month-long open enrollment. And this list of plans, this table is divided in two. On the left side, we have non-Medicare eligible options. So if you're not yet Medicare eligible yet, you have not yet reached the age of 65, or you don't have the qualifying conditions that get you Medicare eligibility prior to age 65, you'd be looking at these plan options. If you are Medicare eligible, you're looking over here on the right side. And we have two different options here. Now you'll see that we have two group plan carriers, Kaiser Permanente and United Healthcare. And then we also offer individual plans through Via Benefits, uh, whether you're not Medicare eligible or Medicare eligible. So what I'm going to do is I'll show you the non-Medicare group plans first, then I'll show you the Medicare group plan, and then I'll talk about individual plans all at one time because it's more efficient that way. Okay, so let me show you the premiums for the group plans if you're not yet Medicare eligible first. And I'm just going to show you the premiums and give you a couple of details. The full details for our plans are always in our enrollment guide that we publish every year. This is a 36-page booklet. You can access the PDF at acera.org/guide. Okay, so these are the premium costs, the premium amounts for our non-Medicare group plans. We have two group plans, the Kaiser Permanente HMO, United Healthcare Signature Value HMO. These are basically the same plans the county offers because they actually negotiate our group medical plan contracts, and our retirees are commingled into their plans. To enroll in these group plans, you have to live in the service areas. And the service areas are San Francisco area, Sacramento, Fresno, Southern California, and Santa Cruz for Kaiser. If you live in the service area, you have to select one of these group plans. Currently, you cannot select an individual plan, but we may change that this year depending on what the board decides. Okay, you'll note that the Kaiser Permanente HMO is the lowest cost plan here if you're not yet Medicare eligible, and it does cost uh, over $1,100 just for your self premium. And you'll also note that the um, the monthly medical allowance, even at the 20-year mark, doesn't even get anywhere near that 687.21. Okay, so you would end up paying the difference for that. So let me show you how that works. This is if you enroll in one of our group plans. This is a very crude illustration of your Acera check stub. So you got your gross pay coming in, and then you have the Kaiser HMO, this person enrolled in Kaiser. So you see that deducted from the check. And we do that as a courtesy to you to make it easy for you. We will take your group plan premium out of your check, send it over to Kaiser for you or United Healthcare. Okay. So now you're down some money. If you're eligible for the 20-year monthly medical allowance, like this person is, then we put that back into your check. And so then you end up paying the difference between what the subsidy covers and what the full cost is. And one thing that I like to point out is that the monthly medical allowance and all of these subsidies, none of them are taxable coverage, or I'm sorry, taxable income. So this monthly medical allowance is not taxable income. The dental vision, Medicare Part B, not taxable income. We have it worked out with the IRS, so you don't have to pay taxes on that. Okay, and just to go back to the non-Medicare group plans slide real fast, you can enroll Self Plus One and family. Copays are $15. Okay, now if you're Medicare eligible and you want to choose our group plan, then you can choose the Kaiser Permanente Senior Advantage plan. Again, there's those same service areas. And what you have to do is you have to enroll in Medicare first. So the way these Medicare connected plans work is that once you turn 65, you enroll in Medicare, and the federal government pays the majority of your cost for healthcare. And then if you want to, you can sign up for these extra plans through an insurance company that give you a higher level of coverage than Medicare alone. This is an example of that. So Kaiser Permanente Senior Advantage Plan gives you a higher level of coverage than just plain old Medicare. Now, you can just take plain old Medicare and not worry about this, but this does give you a higher level of coverage. And if you have at least 15 years of a service credit, you'll see the premium is way lower than if the non-Medicare plan because the federal government is paying most of the costs. So the premium is 398.05 per month for just yourself. Okay. And then what I've done here on this slide is I have also included the different premiums if you have different family members enrolled. And I've included a row here for the monthly medical allowance. And then I've subtracted out the monthly medical allowance so that you can see the out-of-pocket cost for you in each case. And I did that because I wanted to illustrate this additional idea that one of the rules about the monthly medical allowance is it only pays up to the amount of the group plan premium if you enroll in a group plan. So the premium for this is 398.05, but you'll notice that the 20-year monthly medical allowance in this case is also 398.05, but that wasn't one of the monthly medical allowance amounts on the chart. The 20 years was 687.21, but the board has this rule that it only pays up to the amount of the self premium, so you don't get to keep the change. But what that does mean is that if you have at least 15 years of a Sarah service credit, it's basically a free plan for you. You enroll in this, you get a higher level of coverage than Medicare alone. Your out-of-pocket cost is zero for yourself. So it's free. If you have 10 years of a service credit, it's still super cheap because the monthly medical allowance is 343. And so you only end up paying an additional like what is that, 50 some bucks to be enrolled in this much higher level of coverage than Medicare alone. Okay, now those are the group plan options. Let me tell you about the individual plan options through Via Benefits. First off, let me start with who can enroll in an individual Via Benefits plan. If you are not yet Medicare eligible, so you're under age 65, you have to live inside the US. So we have plans all over the US. But currently, you have to live outside of the Acera Group plan service area. So if you lived in Oakland or San Leandro, you couldn't enroll in a Via Benefits individual plan if you're not yet Medicare eligible. But then if you moved up to Redding, that's outside the service area. If you move over to Nevada, that's outside the service area. Then you can choose an individual plan through Via Benefits. Now, having said that, there is an agenda item coming up on a future board meeting where we are going to discuss whether we want to keep doing that or just open it up to everyone who's not yet Medicare eligible, and regardless of where they live in the U.S., to enroll in these individual plans. So that could change this year. So we'll see. We'll see if that happens. Now, Medicare, if you're Medicare eligible, all you need to do to enroll in a Via Benefits individual plan is you have to live in the U.S. and you just have to enroll in Medicare, Parts A and B. So you can live in Oakland or wherever, San Leandro, inside the group, the Kaiser service area. We don't care. You can enroll in an individual plan if you want. Okay, now what is Via Benefits? Via Benefits is basically a massive insurance broker, and they call themselves a private healthcare exchange. What we do is we contract with them to provide the service of matching you with an individual plan that's right for you, and also providing you the reimbursements for the monthly medical allowance that you are eligible for. So I'll talk about that in just a second. But so Via Benefits, they have contracts directly with 100 insurance carriers. And so there's plans all over the nation. They have thousands of plans. And what they do is they help narrow the plans down for what's right for you. So you can use their website, you can narrow the plans down online, or you can call them. If you call, you'll talk to a non-biased benefit advisor, and they'll narrow the plans down to what's right for you. So you're basically choosing, it's basically based on where you want to live, how much coverage you want, like what level of coverage, how much you are okay paying for it. And you can even get as granular as what doctors you want to visit and what prescription drugs you need. So the website and the telephone call will help narrow down the plans for you, and then you choose the plan that works for you. And you can use the MMAs to pay for not only the premiums for those individual plans, the monthly costs, but also if you choose a deductible plan, it will help you pay the deductible. Also, copays and IRS approved medical expenses. The monthly medical allowance payment works a little bit differently with these plans. We don't put the monthly medical allowance into your retirement check for you if you're eligible for it because it's a little more complicated. So we have to do it this way. What happens is, let's say that you, through Via Benefits, sign up for an individual plan, an individual insurance plan. Okay. Well, what Acera is going to do is if you're eligible for the monthly medical allowance, we are going to send your monthly medical allowance dollars over to Via Benefits, and they're going to deposit those in a health reimbursement account that they manage for you. So this is one of the things that we contract with them to do. Okay, now they will help you enroll in medical insurance coverage directly with an insurance company. You will pay that insurance company directly, but they will help you set it up so where it's all electronic and automatic. You're out some money now out of your bank account. Okay, now you have medical insurance. You're going to go visit the doctor. You're probably going to pay a copay. So you pay the doctor the copay. You're out some more money. What then you will do is you will use your Via Benefits app, or you can do it on the website to submit a reimbursement claim back to Via Benefits, and they will pay you your monthly medical allowance dollars out of your health reimbursement account to reimburse you for those expenses. And they'll help you set, again, all that stuff up electronically and automatically and recurringly. Okay, so one more thing that I want to say about the monthly medical allowance before I move on is if you are Medicare eligible and you choose a Via Benefits medical plan, an individual plan, what the Board of Retirement has found is that these plans, these Medicare plans, are so inexpensive that they have decided to have a slightly lower amount for the monthly medical allowance for people who are Medicare eligible in the Via Benefits plans. Okay. So you'll note that these are a little bit less than the other amounts, but they do keep track of it and they find that 90% of the time this is totally sufficient to cover everyone's the enrollee's expenses for the entire year. Okay, so that's medical. Those are the medical plans, medical subsidies. Let me show you the dental plans and the dental subsidies. We have two dental plans. They're both through Delta Dental. We have the Delta Dental PPO. We have Delta Care USA. PPO is a nationwide plan. Delta Care USA is California only within certain service areas, I think. And you can see that the table here is kind of split in two. And that's because over on this side, if you retire from Acera with at least 10 years of Acera service credit or a service-connected disability retirement, you have to at least sign up for one of these plans, but it doesn't cost you anything for just yourself. The self premium and the subsidy amount are the same. So let's say you retire from Acera with 10 years of service credit and you choose Delta Dental PPO for yourself and you enroll in that. You get your retirement check. In the deductions column, you'll see 5435 come out of your check. In the additions column, you'll see 5435 go back into your check. Costs you zero, and we'll send the premium over to Delta Dental for you. Same thing with Delta Care USA. The self premium is $19.96. The subsidy is $19.96. Now, if you enroll Self Plus One, totally fine. You just end up paying the difference between this premium and the subsidy amount. So you'll see 54.35. I'm sorry, you'll see 105.54 come out of your check. You'll see 54.35 come back into your check, and you'll pay the difference. Now, this half of the table, voluntary enrollment, if you have less than 10 years of Acera service credit when you retire, you can still enroll in our dental coverage. It's just that you don't qualify for the subsidy. And there's a different set of premium amounts, but you can see what those are here, and you can enroll self, self plus one, or family. Okay, vision plans, very similar. Mandatory enrollment if you have at least 10 years of Acera service credit or service-connected disability retirement. And if you enroll in the VSP standard plan for just yourself, it's free. It doesn't cost you anything. The self premium and the subsidy amount are both $4.63. And again, you can enroll self plus one and family, and you would just get that $4.63 subsidy. Now, this one's a little bit different. You could buy up into the premium plan, which gives you a slightly more coverage, but the subsidy amount doesn't change. So it still stays at $4.63. So you would pay the difference between 1663 and 463. The difference between the plans you can again see in our guide, acera.org/guide. One I know off the top of my head is a premium gives you frames every 12 months, standard gives you frames every 24 months. And again, with less than 10 years of Acera service credit, you can still enroll, you just have to pay your own way. Okay, we got two more non-guaranteed benefits, and then we will get ready to transition into the deferred comp presentation. Okay, so Medicare Part B reimbursement plan. What this does is if you're age 65 or older and you want medical coverage through us, we mandate that you choose one of our Medicare options. Okay. Now, if you choose one of our Medicare options, of course, we mandate that you first enroll in Medicare, and that comes with a cost. Because it comes with a cost, we're going to give you a subsidy to help offset that cost. Okay. So, what you do is you enroll in Medicare. Medicare Part A is hospitalization coverage. Medicare Part B is coverage for doctor's visits. So, you got to enroll in both A and B. And then if you have paid into the Medicare system for at least 10 years, Medicare Part A is free. You don't have to pay anything for it in retirement. If you have not, you can still enroll in Medicare. Everyone can enroll in Medicare once they reach age 65. It's just if you don't have enough credit paying into Medicare, then you'll have to pay a little bit for Medicare Part A. Okay, now everyone has to pay for Medicare Part B. And they will, once you start collecting Social Security, they will take it out of your Social Security payment. If you haven't started that, they'll charge you quarterly for it. And there is a range of costs that they'll charge you for Medicare Part B based on your income. The lowest cost, based on the lowest income for 2026, is $202.90 per month that they charge you. Our board of retirement has set the Medicare Part B reimbursement plan at that same amount. You'll note that the income categories are actually pretty big. So the vast majority of people only pay 202.90 for Medicare Part B per month. And if you have at least 10 years of Acera service credit, all you do is you enroll in the Medicare Part B plan. So you just enroll one time. You send us the enrollment form for the Medicare Part B reimbursement plan, and we will start putting $202.90 in your retirement check to help you pay for the cost of being enrolled in Medicare Part B. Okay? So, it's pretty easy. We remind you every year in the enrollment guide to enroll in this. Once you approach Medicare eligibility, we'll also send you a letter in the mail telling you, giving you some instructions about Medicare and also reminding you of enrolling in the Medicare Part B reimbursement plan. If you go to acera.org/Medicare, this is our page that walks you through Medicare eligibility, how it works with Acera, what Medicare is, what are your coverage options, how to sign up, when to sign up, how to enroll in your Acera Medicare plan. So it's a step-by-step process, and we give you all that info at acera.org/Medicare. Okay, so Last non-guaranteed benefit is the supplemental cost of living adjustment. This maintains your buying power at 85% of what it originally was at the time that you retired. Okay, so if you ever lose 15% or more to inflation, and that means that if you have more than 15% in your COLA bank, this supplemental cost of living adjustment kicks in and keeps you at 85% of your original buying power in retirement. It's a very powerful benefit, and it means that you can never lose more than 15% of your buying power to inflation. So it's a very important benefit. When we survey our members about and we ask them to rank all of these non-guaranteed benefits, this one always comes in second after the Medicare, the medical coverage. Okay, last item, understanding life events, working after retirement. If you want to work after retirement, you can feel free to do that. You have some various options here. Option number one, you can work somewhere else. If you go work somewhere else, we don't care where else you work. And when I say work somewhere else, I mean not for one of our six participating employers. You work anywhere else, not for one of those six employers, and we're just going to consider you an Acera retiree. You get your retirement payments every month for the rest of your life. So you can work, get a part-time job somewhere or like do what you like. Option number two, if you want to come back to work for one of those six participating employers, you can. You have two sub options under that. Option number A, option letter A, is that you can continue your retirement payments while working for one of our six employers. However, there are some caveats. You do not earn any additional credit toward an additional retirement. There are restrictions, including a waiting period. There's some duration limits. You can basically only work half time. So you're going to want to read through those. Okay. That's option A. Option B, if you want to come back to work for one of our six participating employers, this is brand new as of last year. You can pause your Acera retirement payments. If you pause your Acera retirement payments and go back to work for one of our six participating employers, you actually earn a second retirement. You earn additional credit toward retirement. At the second retirement, we'll restart your first payments, and you'll also get all the COLA catch-up payments that you would have gotten had you stayed retired. Okay? There is more information about that at acera.org/working. Some other life events. If you defer your retirement, which means you stop working, you don't retire immediately, you defer your retirement to a later date, there's some stuff you're going to want to know about doing that before you do it at acera.org/deferred. Okay, when I told you about the retirement allowance options, the five options, I talked only about death benefits for you dying after you retire. Should you die before you retire, which happens very rarely, there are death benefits available to your beneficiaries. So you can learn more about those at acera.org/death. There is this thing called the advanced death benefit election. Every active member should do this because it ensures your beneficiaries get the maximum continuance, the maximum benefits after your death, and we can't pay them the maximum unless you make that selection. It's very easy. You just check one checkbox on the form and turn the form into us. There's more info at acera.org/ADV. And you can make the election, the beneficiary designation form, and make the election with the checkbox, acera.org/BEN. Okay, next item, next life event, divorce or domestic partnership dissolution. I referred to this earlier. If you were married or in a state registered domestic partnership while you were earning retirement benefits with Acera, those your retirement account is community property when your assets get divided. So you're going to want to probably understand what the options are around that. Because we don't necessarily, you don't necessarily have to divide your Acera account. You could negotiate in that settlement, you could negotiate away some other assets to keep your Acera retirement to yourself. So that is an option. So there's more info about that at acera.org/divorce. Disability retirement. I didn't really touch on this much. Disability retirement is kind of a separate track So I talked about the regular, what we call service retirement. Disability retirement is where you become permanently disabled while you're working, and you basically need to retire early. You're not going to do the other retirement that you were planning on. So we have this opportunity to apply for disability retirement if you can no longer perform your job duties. Um, there's a whole section on that on our website at acera.org/disability. You can even apply for the regular retirement while you're waiting for the disability retirement process. And there's more info on that. Relocating after retirement. Once you retire, just please update your address with us. It's very easy at acera.org/address so that we can continue sending you official correspondence, our annual report, and the open enrollment packet that we send to everyone, all retirees in retirement every October. Okay, if you have any more questions that you think of later, you can email us at acera.org/contact. We will divert you into your member direct account because we are mandating that members email us in their member direct account these days to keep it secure. So you will have to start one if you haven't started one yet. Or you could call us anytime during business hours, 510-628-3000. We have an entire call center. Their only job is to answer your questions about your retirement. Okay, so we're there for you. We are here for you. We want you to understand your retirement and help you plan for it. So on behalf of Acera's Board of Retirement and Acera staff, we wish you a beautiful retirement. You earned it. Thanks for the work that you've done for the residents of Alameda County, and we hope you enjoy your retirement. Thank you. Okay, now at this point, we are going to shift gears, and we ended up doing this a little early, so we're probably let's see, we are almost 25 minutes early on this one, so you all can get out of here a little early. We're going to shift gears over to our uh, deferred compensation expert, Gene Hilliard. Gene, are you there?
I am here. Can you hear me okay?
I can hear you. Yeah. So let
All
me
right,
just
perfect.
introduce you.
Hmm.
Gene Hilliard is the deferred compensation expert that Alameda County has hired for many years to provide this type of education to the employees of Alameda County. Um, and if you're not an Alameda County employee, but one of the five other agencies, 99% of what he's going to have to say still applies to you because as government workers, you all have the ability to save extra money in a 457B account. It's kind of like a 401k, but for government workers. It's kind of special. And even if you haven't started one yet and you're getting close to retirement, he's probably going to tell you some things that you might want to know, and you can do a little bit of catch up and get started with that. And if you do have an account, he's going to tell you about disbursements that you're going to want to take, different info about that in retirement. Okay. So, Gene, looks like we can see your presentation is looking great. So, thanks for being here and
Absolutely.
take it away.
All right. Well,
And this
good
is going to last about 30, 45 minutes.
afternoon.
Yeah, okay, good.
All right. Well, good afternoon, Alameda County family. Again, as Mike mentioned, my name is Gene Hilliard. I'm Vice President, Financial Advisor of Emerge Financial Group. We're a financial services company in Oakland. We were hired roughly 16 years ago, at the time by Prudential and now Empower, to provide retirement planning, investment guidance, and also education. I'm a 23-year vet in the financial services industry, helping my clients create wealth, maintain that wealth throughout their lifetime and the lifetime of their kids and grandkids. And I'm proud to say that I'm a retirement counselor as well. And my goal as a retirement counselor is to help each and every one of you maintain your current lifestyle in retirement, if that's possible. What exactly does that mean? Well, uh, financial planners typically say, and I believe Mike might have mentioned it, or maybe not, that you're not going to need 100% of your salary when you retire. Figure you're going to need about 70 to 80% of your retirement. Um, but for me, I'm big on more is better. Let's shoot for 100. But if we have to settle for 70 or 80, then so be it. Okay. Today, this meeting is predominantly for pre-retirees. You're getting close to retirement. You're maybe less than 5 years away from retirement. And I believe it's important that you plan toward a better retirement by knowing what to expect along the way. And that's kind of what we're going to be talking about throughout this presentation. As Mike mentioned, roughly 30, 45 minutes. Okay. So let's start with what we're going to talk about for the most part in this presentation, the retirement mile markers. We're going to talk about conducting a situation analysis. We're going to talk a little bit about retirement income, Social Security. I'm going to briefly touch on health insurance. We'll talk a little bit about estate planning, drawdown, meaning withdrawal strategies in retirement, and we'll talk about required minimum distributions. So, what is a current situation analysis? What are some of the items you want to have handy when you're creating or conducting a situation analysis? You want to start with retirement savings to date. What do you have in your deferred comp? What do you have in your 403B from a previous employer or 401k or any assets that are earmarked for retirement? You want to project or have handy your Social Security benefits. What should you expect to receive at age 62, at age 66 or 67, depending on your age, and at age 70? Again, available assets that are earmarked for retirement, your current expenses. All right, what are you paying right now in terms of PG&E, water, garbage, mortgage, rent, etc.? What are your current expenses? What are your projected future expenses in retirement, right? Maybe you're going to have that house paid off by the time you retire. So your future expenses may decrease, but we want to have a kind of a idea. You want to look into the future and see what your bills are going to look like in retirement. Okay? So that's your situation analysis. Now let's dive into suggested milestones. Say you're age 50. You want to check in to see if, especially if you're a max contributor, you want to make sure that you're contributing the max because typically the minimums or maximums typically go up roughly $500 a year. Last year, I believe it was 23.5. This year, I believe it's 24.5 or something like that. And I'm going to go into the details a little bit later, but the maxims have gone up. So you want to take a look at that. If you're 59 and a half, you want to know the pros and cons of early withdrawals. Now, the good news for you, or many of you, if you participate in deferred comp and you've made all of your contributions out of your paycheck as an Alameda County employee, this whole 59 and a half is completely irrelevant. However, and it doesn't apply, but if you've rolled in money from a previous employer, say from a 401k, a 403b, or an IRA, then the 59 and a half deal in terms of the penalties may apply. But if you're 59 and a half and you're still working, don't just pull money out of your previous 401k plans, et cetera, just for the heck of it. Sit on that because that's still retirement assets. 62, the earliest age in which you can collect Social Security. So kind of have that in the back of your mind. That is an option, especially if you're not working. I'm against collecting Social Security at age 62 when you're still working, but that's my opinion, and we'll talk a little bit about that later. 65s, you want to be thinking about signing up for Medicare. 66 is where you can collect full retirement, depending on your age. And we're going to talk about the age in which you can collect Social Security at age 66. But if you were born in 1960 or later, then it's age 67 where you can collect full benefits. Age 70 is where you can pretty much get the max Social Security benefit. And age 73 is when you want to start thinking about required minimum distributions. Okay, so let's talk about those, talk about what you should be thinking about when you're less than 50. And I want, if you're a sheriff deputy or you're a safety employee, you want to kind of be looking at this because you folks can retire a lot earlier than most general members. But when you're under 50, continue your contributions, manage how much you're contributing, increase. You want it to hurt a little bit, okay? Review your asset allocation. What is asset allocation? Asset allocation is basically a portfolio strategy designed to reduce your risk by combining several asset classes, mid cap, small cap, international, bonds, etc. So review your asset allocation if you're under 50. Make sure it's in line for your long-term goals. And then review your retirement strategy, right? That pretty much closely aligns with asset allocation. You want to review your retirement strategy. You want to make sure or confirm that you're contributing enough to deferred comp to accomplish your retirement goals, right? You want to confirm that your assets aren't basically put in one basket. You don't want to have all your eggs in one basket because over time, at least I can tell you this, over the past few years, the markets have been performing extremely well. And there are a lot of folks that really don't realize that there's a excessive risk in their portfolio because of the way where the markets has gone over the past few years. So review your asset allocation, review your retirement strategy, and estate planning. Most people believe that only rich people should think about or even consider estate planning. But if you own a home in the Bay Area, you have a few $1,000 or more in a savings account, brokerage account, etc. You want to make sure that those assets pass on to the next generation in the most tax efficient way possible. And help map out your course. And I can help you with that. And I'm going to give you my contact information a little bit later, so we can make sure you're on track to retire the year in which you anticipate, or maybe even retire sooner. All right, so you're 50 plus. What should you be thinking about? Maxing out, catching up. When you're 50 plus, the IRS will allow you to contribute $8,000 more than the normal maximum. So you want to take a peek at that to see if there's room in your budget to put more in your deferred comp or your 457 plan. Estate planning is also important when you're 50 plus, and make sure your beneficiaries are up to date. Okay. And so let's dive into each, three of those items right now. So here's the 2026 IRS limits. As I mentioned earlier, if you're under 50, max is 24,500. If you are 50 and over, you can add an additional $8,000 to that number. Okay. If you have some money in the budget for an IRA and your income does not exceed certain maximums in order to get the full deductions, IRA is 7,500. If you're 50 and over, the IRS will allow an additional 1,100. And what's relatively new, this is probably in the second year, if you're between 60 and 63, there's an even bigger catch up that you can participate in. So in addition to the 24,500, the IRS will allow an additional 11,250 contribution on top of the 24,500. Okay. And then there is the last 3-year special catch up where if you are roughly 54 and a half, you have to be 3 years away from normal county retirement age. You can invest a total of 49,000. That's the max for 3 years prior to retirement. So you can do that 49,000, 49,000, 49,000. Now you don't necessarily have to retire in that third year. You'd have to go back to the 50 and over catch up, but you're allowed to put quite a bit of money into deferred comp. Now, many of you are thinking, well, shoot, 49,000 is a big number. How in the world can people afford that? Well, In my experience, working with county employees, some folks have money sitting in the credit union, earning very little. Now, interest rates are relatively elevated right now, but they're coming down. But when the interest rates start to come down, you might want to maybe reposition that money that's in the credit union into your deferred comp. Now, you can't just write me a check for 49,000, unfortunately. So we have to kind of indirectly move that money into deferred comp. This is how you do it. You tell the county, tell your payroll, I want to invest half my paycheck into deferred comp. So you can say, I want to put in 50% of my paycheck. You get paid, and you're like, oh my gosh, how am I going to pay my bills? Well, the good news, you can just go to your credit union account, pull money out of that account to pay your bills. So you can continue to do that until your savings account dwindles to a number that you feel comfortable with, maybe $10,000. Then you can go back to payroll and say, hey, I want you to revert my deferred comp back to $500 a paycheck, or et cetera. So for those of you who are interested in the 3-year catch up or the other catch ups and you're just trying to figure out how to maneuver this situation, please don't hesitate, reach out to me. Okay. So let's talk about estate planning. There's taxes involved, inheritance taxes. There's wills and trusts that are involved with estate planning. Um, Family heirloom. Make life easier on your family and make sure that it's in writing that you want certain items to go to certain relatives, right? Make it easy on everyone. I have a couple of cousins who, unfortunately, they were almost the best of friends. My uncle passed away, and unfortunately, my cousins are still fighting over their inheritance. So I implore each and every one of you to kind of make life easy on everyone. If something unexpectedly happens to you, you want to make sure it's a pretty seamless process. Okay. Living trust. What's the importance of a living trust? If you don't have a living trust, um, more than likely you're going to have to deal with probate. What is probate? Probate is it's a judicial process where the state will dictate uh, who's the rightful beneficiaries. This is where the state or the court judicial system dictates who the rightful beneficiaries of your estate are. Even if you have kids, still has to go through probate. Okay. Probate typically, at least in my experience, it could last up to 12 months. So your rightful beneficiaries have to sit on the sidelines for 12 months before they get what's rightfully theirs. Okay. I've had a situation where family members come out of the woodwork saying, hey, I should be getting my fair share, when the person who passed away hadn't seen that person in 20 years. Okay. So this is where if you create a living trust, you can bypass probate. The other way in which you can bypass probate is to make sure that you have beneficiaries on all of your accounts. So obviously with deferred comp, you're required to have a beneficiary, but you want to confirm that. And nowadays you can enter beneficiaries on bank accounts. So at a minimum, make sure you have beneficiaries listed on all of your accounts, because that is a way you can avoid probate. And you can also hold property jointly to avoid probate. Talking about beneficiaries, log on AlamidaCountyDCP.com, enter your user ID and password, and update your beneficiaries online. If you don't remember, because I believe in the past with Prudential, it was all paper-based, so you wrote it down. So we weren't doing a whole lot online. So when you first signed up for deferred comp, I'm sure we have something online that lists who your beneficiaries are, but skip all that and just go online and just update your beneficiaries right there. It's pretty simple. Now let's talk about the 60 plus milestone. What should you be thinking about? Well, start thinking about when to take Social Security. Are you going to collect it at 62 or 66, 67, or at age 70? Start thinking about that. Determining your full retirement age. Is it 66 or is it 67? Calculating benefits. And I'm going to talk a little bit about and taxes. So let's dive into that. What is full retirement. Depends on your age. So to the far right, if you were born in 1960 or later, 67 is your retirement age. Okay. If, for example, you were born in 1957, full retirement is 66 and 6 months. And this is important. You need to kind of know exactly where full retirement is, because if you were born in 57 and you look to collect Social Security at 66, exactly on your birthday, you're shortchanging yourself. You got to wait until you're 66 and 6 months or whatever it is. Okay. To confirm exactly what your full retirement age is, go to ssa.org, create a user ID and password. System will tell you exactly what your full retirement age is. Calculating benefits. How does this work? Well, in a nutshell, the government looks at 35 years of work history, and they take pretty much the average of that up to a certain amount, and that's how they calculate what your benefits are. If you took some time off, between jobs, possibly a year or two, then that's going to drop your average salary because your income is zero. I would make sure, I would encourage all of you to log on to ssa.org, confirm your earning history, because there are errors that are made from time to time. And you just want to make sure that your earning history is accurate on their website. Okay. So full retirement, if you collect, you get 100% of whatever it is. But as you can see, the earlier you collect your Social Security, you're going to take a bit of a haircut. So if you collect Social Security at age 62 versus full retirement, you're looking at a 25% monthly cut of your benefit. So you would have gotten a lot more if you waited. Okay. So that's pretty much how it works. If you collect Social Security prior to full retirement, it's going to drop your benefits, here and there. So be careful when you're thinking about, when exactly you want to collect Social Security. Is it taxable? If your income, say you're single, or if you're married, if you're single and your income exceeds $25,000, then you're looking at a portion of your Social Security being taxed. And if you're married, filing jointly, if your income exceeds $32,000, a portion of your Social Security may be taxable. I would encourage you also, because I'm not a tax advisor, check with your tax person, confirm with him or her whether or not you're in your situation, whether or not your Social Security will be taxable or not. Okay. 65, I'm going to jump through this real quick. That's Medicare age. But you also want to start thinking about your withdrawal strategy in addition to Medicare. And I'm going to talk a little bit about that. Withdrawal strategy, your plan to withdraw your funds, determine how much and when. So if you're retired, you're collecting your Social Security, you're collecting your ACERA, you have a chunk of change in deferred comp. You want to be responsible with that money. You don't want to overspend because you can run out of it pretty quickly. So I encourage folks to start at, if you need to withdraw money, start at 4%. So 4% of your deferred comp balance, take that out per year minus taxes. Start there. And then you can adjust it based upon your rates of return in your account. You can adjust it based upon your needs. You don't want to withdraw money if you don't need it because you're paying taxes unnecessarily. Okay. So as a recap, 4% is a good number. But if you're interested in getting more details about your personal situation, please do not hesitate and reach out to me. 65, you want to be thinking about your health care and insurance costs, Medicare, etc. Okay. What are risks, or what are the assumed risk in retirement? So you've spent a lot of time up to this point in the what I would call the accumulation phase, right? You're just building assets. You're focused on building your deferred comp balance. You're focused on increasing your wealth. Now you're retired. Some people think, well, all I have to do is just sit back and relax, but there's still some risk associated with retirement? What are the risks? Market volatility, market going up and down. Your tax strategies. Should you go with the Roth, or you should go with deferred comp? Did you make the right decisions? Low interest rates. If you're the type of person that wants to go run and hide in a savings account in retirement, we know interest rates are going to probably drop to the 1.5%, 2% range. And when you do that, you have inflation risk. Inflation typically is about 3% a year. So if you're only earning 2%, inflation is at 3, you're actually losing money as you're aging. So there's still some risk associated with that. And then, lastly, longevity. Running out of money is a serious concern for a lot of folks, and that's where you want to be thoughtful. You want to be responsible about how you're spending your money. Okay, back to 65. Evaluate your Medicare options. Enroll in Medicare. Sign up Part A and B. And here, Part B is a typical cost. Don't quote me on that. Mike probably has a better number, at least nowadays. And this is from 2025, so this is a little outdated. But nevertheless, doctor visits are going to cost you a little bit. It's not free. Okay, and you want to make sure that you sign up when you're supposed to sign up, because there could be severe penalties by not signing up for Medicare when you're eligible. Okay. Now let's dive into required minimum distribution. Remember, it used to be 70 and a half. This is where you're required by law to start taking out a portion. How much is it, Gene? It's roughly 4 to 6 per year in and year out. And if you don't take that required minimum distribution, you can be hit with some severe penalties. Back in the day, you used to get hit with a penalty of 50% of what you should have taken out. Now it's like 25%. Now, for those folks who continue to work at 73 or older, you're not required to take money out of your deferred comp. If you have IRAs, 401ks at previous institutions, yet you're still working with Alameda County, you're required to take the minimum distribution out of those accounts. But if you have a deferred comp account with Alameda County, you spent your entire career here and you're still working past 73, RMD does not apply to you. However, as soon as you quit, as soon as you leave county service, the RMD is going to kick in. Okay. I would also encourage folks, when you're RMD age, when you get that letter from Empower, I would encourage you to have Empower set up that RMD amount, because they can calculate it every year for you. Have them calculate it for you and send it to you automatically. Pop it in your checking account, right? Because I have found that as you age, especially if you don't need the money, you may forget. And if you forget to take that RMD out, then there's serious consequences for that. So have Empower set up your RMD where they send it to you automatically, and then you never have to worry about it. You'll open your checking account or you'll open your mailbox and feel like maybe this is free money, but RMDs are extremely important. RMDs also apply, unfortunately, to Roth 457Bs as well. Now, a Roth IRA is different. There's no RMDs associated with Roth IRAs, but with a Roth 457 or a Roth deferred comp account, required minimum distributions still apply. So that's important to know. People get a little confused on RMDs for Roth IRAs and RMDs for Roth 457s. Okay. Once you retire from the county, you have $500,000 in deferred comp. You do not have to make a rash decision at that point in terms of deciding to move the money out. You're not required to move the money out. But I encourage folks to leave the money here, wait for the dust to settle, because you're going to have a lot going on when you retire. And then once you get your feet set, you're comfortable, then you can make a decision in terms of what to do with your deferred comp. But I can tell you, many participants can benefit. Just leave it in the plan. If it's worked for you up to this point, you can leave it in the plan. You got publicly traded investments, the same mutual funds. You have Fisher Investments. If you want to create a managed account, you have Goldmaker. You have access to me as well at no charge or no additional charge. So visit with me, leave your money with the plan. But if you decide you want to roll out, then that's fine. If, for example, you'd rather invest in stocks and not mutual funds, we don't offer stock investments per se in deferred comp, so it may make sense to roll out. Or maybe you want to use your money to invest in a self-directed IRA to buy real estate. That's not available here, so you may want to roll out. So there's reasons or rationale for moving money out, but I'd say for the most part, uh, if you're unsure or you're not an expert in the market, leave the money here, and then we can help you manage it. Okay. So the end is just the beginning. And what do I mean by that? Well, you've spent a lot of time up to this point in the accumulation phase, right? Making decisions in terms of how to invest your money before retirement. And a little bit of the stress doesn't necessarily go away as you retire. So it's just the beginning. You have to understand how to manage your money, making sure that you're responsible in terms of not spending too much of your money, or how that money is being invested, what's appropriate, right? You want to make decisions in terms of what your retirement budget is, estate planning. So the end is just the beginning. Uh, yes, it's the end, but you still have to manage your money, be responsible, be thoughtful, etc., and make what is believed to be the appropriate decisions based upon your family. Okay. Acera, very important. Log on to acera.org. Uh, and I'm sure Mike talked about this. Get a good idea of what your Acera benefit estimate or what your benefit's going to be monthly. That's based upon your age, final average salary, and service credit. So log on to acera.org to get comfortable with how much you're going to receive from Acera. For those folks who maybe have some time they can buy back to increase your Acera benefit, did you know you can use your deferred comp money to buy back service credits, to buy back that time that you were out on maternity leave, etc.? So if you're interested and you want some more details about purchasing service credit, reach out to Mike and his team. Reach out to me if you decided you want to initiate what is called a trustee to trustee transfer out of your deferred comp into Acera to buy that service credit. Great situation. That will inherently increase your monthly benefit because it's going to give you more time on the books. If you haven't already, create a user ID and password for the Empower site to view your holdings, to see if your asset allocation is appropriate, to see if maybe the risk that you're taking on in your portfolio is not appropriate. So log online to review your investments, grab your statements, beneficiary information, etc. If you need assistance with respect to managing your investment or you need some retirement planning assistance, you can meet with Mark, you can meet with myself or Dan or Jose. We're fully licensed and here to help Alameda County employees retire with dignity and comfort. We're here to help you make those important decisions as you navigate that retirement scene. Okay. So with that, I'd love to entertain questions.